Good morning, students. Welcome you all once again in the live virtual revisionary class organized by Board of Studies of ICAI. Friends, today we are going to discuss a very important standard. Today we are going to revise a very important standard. The name of the standard is income taxes, right? So this is the standard which interplay between the Income Tax Act and the Books of Accounts, right? Your Companies Act and Income Tax Act, right? So this standard requires a lot of knowledge from the income tax side. Okay. So friends, this standard, the name is income taxes, right? There are two type of taxes which this standard dealt with. You know, what are those two type of taxes? Number one is current tax and number two is deferred tax, right? So this standard talks about current tax. Current tax means, when I say current tax means tax which is going to be paid or payable for the current year. And future tax, when I say future tax, what is meant by future tax? Future tax means deferred tax. Future tax means deferred tax. Okay. Deferred tax means, for example, you have taken a benefit today. Let's say in Companies Act, you are charging a depreciation at the rate of 10%. For example, there is 1 lakh rupee of machinery, okay, and you are charging a depreciation of 10%, which is on the life of 10 years. So 1 lakh rupee machinery is going to be depreciated for 10,000 rupees in your books of accounts. So you will charge 10,000 rupees for how many years? 10 years. But in Income Tax Act, the rate of depreciation is, for example, 20%. So in Income Tax Act, you are charging a depreciation of 20,000, right? So in the company's books of accounts, you are charging depreciation of 10,000. In income tax, you are charging depreciation of 20,000. So basically, if you see here, in books of accounts, you will charge depreciation for 10 years. And what happened? Your profit will be reduced by 10,000 every year. Okay, you will get a claim, you will get a benefit in your books of accounts. But in Income Tax Act, since you are claiming a higher benefit in the initial years because the rate is 20%, so there will be few years where the benefit will be minimal or benefit will be zero. Okay, so what does it mean? In the future years, while in the earlier years in income tax the tax is low, but in the future year the tax is high. It means you are postponing your tax liability by claiming a higher depreciation in Income Tax Act, right? Right? So you are claiming means because it is permitted, because the law permits you. So this is known as a deferred tax. This is known as a future tax. This is known as a deferred tax. Deferred tax means the tax which you are going to defer. Current tax means the tax which you are paying into the current period. Okay. So the tax belongs to the current period. For example, you pay advance tax, self-assessment tax. What is that? That is the current tax. That is the current tax which you are paying for the year. Okay. What is deferred tax? Tax which you are going to postpone, which you are going to defer. Okay. So friends, moving further, right? Current tax we discussed, it is amount of income taxes payable, or recoverable in respect of the taxable profit or taxable loss for a period. Deferred tax means taxes payable or recoverable in future period in respect of some temporary differences. We'll talk about some temporary differences and carry forward of unused taxes losses and credits. Okay. Friends, this standard talks about 5 to 10% about current tax and 90% about deferred tax. 90% about deferred tax, right? So let me take you on my Excel file, and with the Excel file quickly we'll revise the concept, and we'll do lot of questions from the Word file also. Friends, as we all are aware, in India we have Accounting Standard 22, which is on accounting for taxes on income, right? So while the title is different, accounting for taxes on income, but the concepts are same largely. Okay, concept means the background is same. In globally in IFRS, it is International Accounting Standard 12, which is known as income taxes, and we have the converged IAS 12, which is known as Ind AS 12, and the name is income taxes. So friends, we are going to discuss Ind AS 12 income taxes. Okay, as I told you, in income taxes we are going to cover current tax and we are going to cover deferred tax. Current tax and deferred tax both, right? So we will be discussing recognition, measurement, presentation, and disclosure of current tax and deferred tax, and we will talk about some specific items. We'll talk about some specific items. Okay. For example, so we'll talk about some specific items also. Now talking about the statement of profit and loss, like total income is 1000 rupees, total expense is 800, your PBT is 200, your current tax is 50, your deferred tax is 40, and your PAT is 110. This is typically your statement of profit and loss where current tax and deferred tax has been presented in this manner, right? So we are going to discuss this current tax and we are going to discuss this deferred tax. We are going to talk about both of them, okay? Current tax and deferred tax, right? Yes. Now friends, before getting into the current tax and deferred tax, just a minute. Let's talk about the current tax concepts. Okay, we'll do a question on current tax and then we'll move to the deferred tax concepts. Friends, first of all, current tax has to be computed as per the income tax provisions. Okay, as I told you, this current tax requires the knowledge of income tax, direct tax. Okay, so when you compute the current tax of any company, it has to be computed in line with the provisions of Income Tax Act. So what is the current tax? If you prepare your return of income, if you prepare your computation of income, how auditor audit your current tax expenses in the P&L? Like I have shown you, you have the current tax expense in your P&L. How auditor will audit that? So every auditor will ask for the computation of income, right? Prepared by the company. Sir, for example, all the listed company which have given their results for the year ended 31st March 2026, they have given their results on their timeline is maximum 30th May 2026, 60 days from the end of the year, right? Sir, these companies, so while they are filing their return of income, because they are subject to tax audit and they are subject to probably tax audit of, okay, and their return of income will be filed by 30th of September or 31st of October, whatever the date may be. Sir, then while computing the current tax expense in their books of accounts for the year ended 31st March 2026, since they are going to file their return after 6 months, so how they have computed? So friends, they prepared their computation of income, right? For example, if they need to file the return before filing of the financial statement, what should be the return of income, what should be the computation of income, right? So they prepare the computation of income, and according to that computation, they compute current tax and they charge current tax expense in the P&L. Okay, sir, but when they actually file, for example, bonus, right? So probably there is a bonus expenses in the P&L, okay, and they are filing their financial statement by 30th of May, and this bonus is allowed on a paid basis. They will finalize their tax audit and file their return of income by 31st of October, for example, and by 31st of October they have paid 100% bonus, right? And now they will claim in their return of income, right? They will claim their return of in the return of income. But while preparing the computation, they were not sure that whether they will be able to pay the bonus by 31st of October or not. So friends, you have to apply your best judgment while preparing a computation of income for the year closing. Okay, so whatever adjustment will be there, right? So your best estimate computation of income versus your return filed versus your actual return filed, the differential adjustment will be done in the next year. Okay, but to cut a long story short, the companies prepare the computation of income just like if they need to file a return of income. Okay, so with that computation of income, auditor audits, okay, this computation of income is reflecting a tax expense of 1 crore rupees, whether this 1 crore rupees is coming into the P&L or not. Okay, this is what it is, my dear friends. Okay, this is what it is. So current tax has to be computed as per the income tax provision. And what is the accounting entry of current tax? Accounting entry is current tax expense, provision for current tax expense account debit to provision for current tax liability, to provision for current tax liability. Okay, what is the accounting entry of payment of advance tax? The payment of advance tax accounting entry is advance tax asset account debit to bank, advance tax asset account debit to bank, right? So in balance sheet, advance tax and TDS needs to be netted off, offsetted from the provision of current tax liability, and the netting has to be year wise only. The netting has to be year wise only. For example, A Limited, A Limited has a provision for current tax for the year ended 31st March 2026 for rupees 25 lakhs. They have deposited advance tax of rupees 10 lakh during the FY 25-26. The 26, okay. The customers have deducted the TDS while making a payment for rupees 5 lakhs. Advise the presentation in the balance sheet relating to advise the presentation balance sheet relating to the provision and advance tax and TDS. Okay. So tell me how this is going to be presented, right? So answer. In balance sheet, provision of current tax, provision for current tax will be presented net of advance tax and TDS. Okay. So it will be shown as a provision for current tax. Current tax is equal to how much? Provision of current tax 25 minus 10 minus 5, right? 10 lakh. 25 minus 10 minus 5, 10 lakhs. Okay. Right? Is that clear? Is that clear, my dear friends? Okay. Yeah. So current tax, so the concept of current tax is very limited given in Ind AS 12. When I say limited given, so basically it is very small area. The larger area is deferred tax. Right? So this is the concept of your current tax. This is the concept of current tax. Okay. You understood these accounting entries, and this current tax has to be computed as per the income tax provisions. Now, friends, let's discuss a question on the current tax. Okay. I hope my Word file is visible on the screen. Is it visible? Is it visible or not visible? Visible. Okay. H Limited is a manufacturing company H Limited wanting to. So this question is on current tax. H Limited is a manufacturing company wanting to calculate its taxable profit or loss for the year ended 31st March 2028. So they want to calculate the taxable profit or loss, okay, as per Income Tax Act. The statement of profit and loss and other comprehensive income, the balance sheet and the notes are given below. The statement of P&L, OCI, balance sheet and notes are given below. Tax rate for the financial year 0708 is 30%. Okay. But the new tax rate of 32% for the year 8, 9 and beyond has already been enacted before the year end. Do we need to do anything for this 32% while computing the tax liability for financial year 207 and 208? 20x8? Answer is no. This 32% is applicable for computation of current tax, computation of tax liability for the year 20x8 and x9 and beyond. Okay. So here we need to compute the taxable profit or loss, the tax liability for financial year 20x7 and 20x8. Okay. So here the rate applicable is 30%. Calculate taxable profit for the financial year 20x7 and 20x8 and the related current tax expenses. Okay. Now, so in the balance sheet, what is given? Quickly run through with the balance sheet. Property, plant and equipment is 4 crore 20 lakh. Product development cost is 21 lakhs. Investment in subsidiary S Limited is 1 crore 54 lakh. Trading investment 72 lakh 80,000. Trade receivable 2 crore 19 lakh 10,000. Inventory is 1 crore 6 lakh 40,000. Cash and cash equivalent 63 lakh and the total is 10 crore 56 lakh 30,000. In equity, share capital are 4 crore 20 lakh, accumulated profit 2 crore 86 lakh 24,330, revaluation surplus also 30 lakh 80,000. There is a deferred income government grant 14 lakh, liability for product warranty cost is 5 lakh 60,000, and there is a deferred tax liability from 20x6 20x7 7 lakh 75,670. Trade payable is 2 crore 67 lakh 40,000, and medical benefit for employee 24 lakh 50,000. The total is 10 crore 56 lakh 30,000. Now, there is a P&L also. Revenue is 16 crore 81 lakh 40,000. The cost of sales is 13 crore 44 lakh. Gross profit is 3 crore 37 lakh 40,000. Operating cost is 2 crore 68 lakh and 80,000. The profit from operations are 68 lakh 60,000 and the finance cost is 9 lakh 10,000. The profit before taxation is 59 lakh 50,000. This is the profit before tax. Okay. Now some notes are given. Depreciation expense for the financial year 20x7 20x8. Depreciation expense for the financial year 20x7 20x8 allowable as per the income tax rules is 72 lakh 10,000. Okay. So depreciation as per income tax rules, allowable as per income tax rules is 72 lakh 10,000. And what is my depreciation charged? Okay, it is not given here. Okay, it is not given here. So depreciation as allowed for the purpose of financial reporting included in operating cost. Okay, it is given here is 59 lakh 50,000. So friends, depreciation as per books, as per Companies Act, as per books, as per Indian accounting standard is 59 lakh 50,000, which is debited in the P&L account. But allowable depreciation is 72 lakh 10,000, means you will claim more benefit on account of depreciation while computing your tax liability. Cost of PP&E, the cost of property, plant and equipment is 5 crore 60 lakh and H Limited deducted expenses of 1 crore 45 lakh 60,000 in its tax return prior to financial year 20x7x8. Further, so cost of PP is 5 crore 60 lakh and H Limited deducted expenses of 1 crore 45 lakh 60,000, deducted expenses of 1 crore 45 lakh 60,000 in its tax returns prior to financial year 20x7x8. The cost of PP is 5 crore 60 lakh and they have deducted expenses of 1.45 crores, right, prior to 20x7x8. Further, as of 31st March 20x8, H Limited for the first time revalued its property, plant and equipment to market value of 4 crore 20 lakh. Revaluation surplus is 30 lakh 80,000. The revaluation surplus of 30 lakh 80,000 is also given, my dear friends. Revaluation surplus is also given here, right? So how I read this paragraph? What is the relevance of this paragraph? Tell me, what is the relevance of this paragraph? क्या relevance है इस paragraph का? What is the relevance of this paragraph? The relevance of this paragraph, that cost of PP is 5.6 crore and the expenses were 1.45 crores. So if you reduce, so basically they are saying the company has already charged 1 crore 45 lakh 60,000 rupees of depreciation from this 5 crore 60 lakh, right? So if you reduce 5 crore 60 lakh minus 1.4560 lakh, so how much it will come? 5.6 minus 1.45 is how much? How much? 4.15, 4.15, and you reduce 60,000 also. So it will come as 4 crore 15 lakh and how much? 40,000? 40,000, right? 4 crore 15 lakh 40,000. I hope I am right. 4 crore 15 lakh 40,000. Further, H Limited. So this 4 crore 15 lakh 40,000 is what? 4 crore 15 lakh 40,000 is your income tax net block. Okay. Further, as of 31st March 20x8, because they are written, the cost of PP is this much and H Limited deducted expense of 1 crore 45 lakh, right? 1 crore 45 lakh 60,000 its tax return prior to financial year 7-8. Further, as of 31st March 8, H Limited for the first time revalued its PP&E to market value of 4 crore 20 lakh. Okay. Revaluation surplus is 30 lakh 80,000. It means in the books, what would have been the value earlier? In the books, the value would have been how much? 4 crore 20 lakh minus 30 lakh 80,000. That is why the revaluation surplus is this much. But friends, do we have any use of this item here? The question is talking about taxable liability, right? And this revaluation surplus will never come into the P&L. Okay. This revaluation surplus is never part of this P&L. It is part of OCI. And this is profit before tax, means OCI is not included here. So do we need to do anything about this information? In this question, answer is no. This information is relevant only for the deferred tax calculation, right? When you compare your book base with tax base, like your tax base is 4 crore 15 lakh 40,000, for example. Okay. And what is your book base? 4 crore 20 lakh is your book base. Okay. Right. Now let's move to the next part. So what is the relevant information in point number 1? The relevant information is depreciation as per the Income Tax Act is 72 lakh 10,000 and depreciation as per the Companies Act is how much? 59 lakh 50,000. Okay. 59 lakh 50,000. I hope this is clear to everyone. Is that clear? Okay. Great. Then my dear friends, in 2004-2005, H Limited incurred product development cost of 35 lakh. These costs were recognized as an asset. So this company incurred product development cost in 2004-5 of 35 lakh and these costs were recognized as an asset and amortized over a period of 10 years. So this product development cost was recognized as an intangible asset. If you see, we have seen this product development cost in the balance sheet. You can see this product development cost of 21 lakh. So this is at 31st March 20x8. But when it was initially capitalized, the value was 35 lakh. And since the amortization is over 10 years, so this was capitalized in 2004-5. So 4, 5, 5, 6, 6, 7, 7, 8, 4 years. Okay, 4 years. And what will be the amortization every year? 35 lakh divided by 10, 3.5 lakh. So 3.5 lakh multiplied by 4-year accumulated amortization. It will come at 14 lakh. 35 lakh minus 14 lakh is equal to 21 lakh. So this is the balance which is given in the balance sheet, 21 lakh, right? So how this 21 lakh have arrived? This 21 lakh have arrived 35 lakh minus 4-year amortization. Okay. So I'm talking about this 21 lakh. Okay. So what is given here? For tax purposes, H Limited deducted full product development cost when they were in 2004-5. What does it mean? For tax purposes, this 35 lakh rupee has already been claimed in 2004-5 itself. It means whatever depreciation, whatever amortization of 3.5 lakh is there, we have to remove that. We have to add back that amortization, right? करेंगे ना? इस साल का 3.5 लाख बुक्स में आया होगा तो 3.5 लाख what we will do? We will add back that 3.5 lakh. Okay? Yes. So sir, point number 1 is clear, point number 2 is clear. Now. So shall I start solving this in my Excel file also? Okay. So let me start solving this in my Excel file also. Question number 1 of Word file. right? Question number 1 of word file. Okay. Shall I start doing that? Yeah. So what is my accounting profit? Profit as per books of accounts. What is my accounting profit? I'll start with the profit as per books of accounts. Okay. So what is my accounting profit, my dear friends? My accounting profit is how much? My accounting profit as per P&L is 59 lakh 50,000. 59 lakh 50,000. 59 lakh 50,000. 59 lakh 50,000. Okay. 59 lakh 50,000 is the profit as per books of accounts. Add, add, add. So basically you have to do additions, additions. Okay. What could be the additions? What could additions? For example, amount disallowed in the Income Tax Act. Okay. Amount disallowed in the Income Tax Act. So addition, what is additions? So disallowance in Income Tax Act, right? So largely disallowance in Income Tax Act. Okay. And here you will deduct deductions, additions, deductions, deductions, which is allowance in the Income Tax Act. Allowance in Income Tax Act. Okay. Friends, in the point number 1, what was the point number 1? Depreciation. The depreciation which you will disallow. What depreciation you will disallow? You will disallow the depreciation as per Companies Act, as per books, right? You will disallow your accounting depreciation. Accounting depreciation you will disallow, and you will allow income tax depreciation. What you will allow? You will allow tax depreciation. Tax depreciation. What is accounting depreciation which is going to be disallowed? It is 59 lakh 50,000. Again, this number is again 59 lakh 50,000. And the tax depreciation which will be allowed is 72 lakh 10,000. Okay. Then there is a amortization of product development cost also. Amortization of product development cost also, my dear friends. So what is the amortization of product development cost? 35 lakh divided by 10. So this will also be disallowed. Why? Because the entire 35 lakh has already been allowed in the first year. So amortization of product development cost. Okay. Amortization of product development cost, which is 3,50,000. I hope it is clear to everyone, right? Now let's move to next part. So we discussed point number 1, point number 2, point number 3. Trading investments were acquired in the preceding year at a cost of 80,50,000. There were some investment which were acquired in the previous year at a cost of 80,50,000. These investments are classified at fair value through profit and loss and thus recognized in their fair value. Fair value adjustment are not allowable by tax authorities. Fair value adjustments are not allowable as per the tax authorities. Okay. So friends, what we did, we have revalued the trading investments, right? So let me take you to the balance sheet. In the balance sheet, what is the value of the trading investment? The value of the trading investment is 72 lakh 80,000. 72 lakh 80,000 is the value of the trading investment, and it is at fair value. But what is the cost of these investment? The cost of these investment is 80 lakh 50,000. 80 lakh 50,000 is the cost, right? And the fair value, the carrying value is 72 lakh 80,000. What does it mean? 80 lakh 50,000 की चीज की वैल्यू कितनी हो गई? 80 lakh 50,000 has gone down to 72 lakh 80,000. It means what is the loss? What is the mark to market loss? Right. So cost of investment. What is the cost of investment? 80 lakh 50,000. 1, 2, 3. 80 lakh 50,000. Then less. So basically fair value or carrying value of investment. And this carrying value is fair value only, okay? So what was the carrying value of the investment? Carrying value of the investment is how much? Carrying value of the investment 72 lakh 80,000. 72 lakh 80,000. It means there is a mark to market loss. There is a mark to market loss of 7 lakh 70,000. Tell me where this mark to market loss was recorded in the books of accounts. This mark to market loss was recorded in the P&L. This was recorded in the P&L, na? This mark to market loss. This mark to market loss was recorded in the P&L, correct? So this mark to market loss was recorded in the P&L, in the operating cost, right? So this has to be added back because the Income Tax Act only allows you the actual profit or loss on the sale of investment. The fair value adjustments are not allowed by the tax authorities. So what we will do? We will add back MTM loss on fair valuation of investment. 7 lakh 70,000. 7 lakh 70,000. Okay. Right. Then moving to the next part. Bad debt provision amounts to 45 lakh 50,000. So there is a provision for bad debt 45 lakh 50,000 and relates to two debtors. Debtor A 28 lakh. Receivable originate in 5, 6 and 100% provision were recognized in the preceding year. Okay. So this bad debt provision was 45 lakh 50,000 and this belongs to debtor A and debtor B. Okay. So this 28 lakh rupees belongs to debtor A and it was originated in 2005, 2006 and 100% provision was recognized in the preceding year. And debtor B 17 lakh 50,000, receivable originate in 6, 7 and 100% provision was recognized in financial year 2007, 2008. Tax law allows deduction of 20% of provision for debtors overdue for more than 1 year, another 30% for debtors overdue for more than 2 years, and remaining 50% for debtors overdue for more than 3 years. You are finalizing your tax return for 2007-8, computing your taxable income for 2007-8. And what is happening here? So there are total bad debt provision of 45 lakh 50,000. This 28 lakh rupee was originated in 2005-6, right? Means 5, 6, 6, 7, 7, 8, right? So sitting on 31st March 20, sitting on 31st March 20x8, what is my, how much is my overdue? How much is my overdue debtors, right? How much is my overdue debtors? Debtor A. So debtor A was originated in 2005-6, okay? So now we are sitting in 7-8. It means it is overdue for more than 2 years. It is overdue for more than 2 years, right? ठीक है ना? 6, 7, 7, 8, more than 2 years, okay? Then your this much 28 lakh rupee of debtor was overdue for more than 2 years, and this 17 lakh 50,000 it was originated in 6, 7. This was originated in 6, 7. So it is overdue for more than 1 year, okay? So tax law allows deduction of 20% for overdue for more than 1 year, 30% for overdue for more than 2 years, okay? For more than 2 years. Friends, now what should I do? What should I do? First of all, how much claim is there sitting in the books? How much claim is there in the books? Books में कितना claim है? Books में कितना claim है? P&L में. P&L में अलग से कुछ दिया, अलग से नहीं दिया, मतलब it is part of operating cost. If it is not written separately, it is part of operating cost. So how much you have recorded? How much provision you have recorded in your books of accounts? In your books of accounts, you have recorded a provision of 100% provision was recognized in financial year 7-8 for 17 lakh 50,000. So what we will do? We will disallow this 17 lakh 50,000 and we will allow 20% of provision for 17 lakh 50,000 and 30% of the provision for 28 lakh. This is what we allow, right? So let me solve here. Let me solve this question here, right? So what we'll do, we'll disallow the provision for doubtful debt. We'll disallow the bad debt provision, provision, because it is part of my profit as per books of accounts, right? Bad debt provision recorded in FY20 X78, okay, which is how much? 17,50,000. 17,50,000. 17,50,000 I have recorded bad debt provision. Now I have to allow this bad debt provision also, right? Bad debt provision allowed as per IT Act. Sir, but we never read this provision of 20%, 30% in our direct tax. Friends, this is an accounting question. So don't apply your mind if question is specifically stating that 20% provision is allowed for more than 1 year overdue debtor and 30% is allowed for more than 2 year overdue debtor. Go by the question. Okay. Yes. So now allowance of bad debt provision as per IT income tax. Okay. So greater than 2 years, first of all, greater than 1 year, greater than 2 year, greater than 1 year and greater than 2 year. What is greater than 1 year provision? Greater than 1 year, 20% is allowed, greater than 2 year, 30% is allowed. Okay. So 20% on how much? 17,50,000 and 30% on 28 lakh. Okay. So now this multiply by this. So what is your total bad debt provision which is allowed? 11,90,000. 11,90,000 is the total bad debt provision allowed. 11,90,000. Okay. Is that clear? Is that clear? Yes. Now the next part. H Limited created a provision for inventory obsolescence in accordance with Ind AS 2 requirement. New provision created in 7.8 was 3,78,000. Total provision is 6,30,000. Being a general provision, this provision is not tax deductible. So, how much provision was created in 2007-8? 3,78,000. In the books of accounts, this claim of 3,78,000 was taken, but it is not allowed. It is not allowed in Income Tax Act. It is not allowed in Income Tax Act. So what you should do? What you should do? You should disallow. You should disallow this inventory obsolescence, inventory provision, right? But will you disallow the total provision? The earlier provision has already been disallowed in the respective earlier income tax computations. So this will be disallowed only. So whatever you have taken in the current year, it will be disallowed in the current year. So how much it is? 3,78,000. 3,78,000. Okay. Government grants are not taxable. Full government grant received in 7.8 is included in the balance sheet. So government grants are not taxable and full government grant received in 7.8 is included in the balance sheet. So the government grants are not taxable. Okay. Now, what to do the treatment for the government grant? क्या treatment करना है government grant का? Tell me. So there is a government grant in the balance sheet. In the balance sheet, there is a government grant. So where is that government grant in the balance sheet? It is sitting at, yes, deferred income government grant 14 lakh rupee. Right. This deferred government grant 14 lakh rupee. Will you find any government grant related aspect in the P&L? No. Right. And this question is saying government grants are not taxable. Very good. Means whatever you have received, you are not going to pay any tax on that. Full government grant received in 7.8 is included in the balance sheet. व्हाट इज द ट्रीटमेंट ऑफ दिस पॉइंट नंबर 6? इसका ट्रीटमेंट क्या होगा? व्हाट इज द ट्रीटमेंट ऑफ पॉइंट नंबर 6? व्हाट इज द ट्रीटमेंट ऑफ पॉइंट नंबर 6? कोई ट्रीटमेंट होगा क्या पॉइंट नंबर 6 का? फ्रेंड्स, फर्स्ट ऑफ ऑल let me make you guys clear. Whatever is given in the question, not necessarily that point needs to be captured in the solution. At times, question is also testing your knowledge and application of mind. See, in the books of accounts, the government grant received in the year 2007-8 is there in the balance sheet. What does it mean? What does it mean? Why it is in the balance sheet? It means what accounting entry you have passed. Bank account debit to deferred government grant. To deferred government grant, it means this entry is not routed through P&L. It means no income has been taken in the P&L. So whatever is the profit before tax from where you are computing your income tax profit, your taxable profit, in your profit as per books of accounts, this government grant treatment is not there. Even in the taxable income, even in the taxable profit, if you are computing taxable profit, this government grant is also not taxable. So it means there is no treatment of this government grant in the textbooks, and there is no treatment you have taken in the company's books. So this point number 6 is just to confuse you. There is no treatment of this point number 6. Okay, right? But if this 14 lakh rupee of government grant has been taken in P&L as an income, but it is not taxable, what you should do? You should deduct while computing your taxable profit. But this is not sitting in P&L and hence no treatment. Point number 7. In 7-8, H Limited increased the liability for product warranty cost by 1,75,000. Increase the liability for product warranty cost by 1,75,000. Product warranty costs are not tax deductible until the company pays the claim, right? So this provision is not tax deductible. While as per Ind AS 37, you create a provision in the books of accounts for warranty. It is required to be created because there is a present obligation arising out of past event. Okay. So product warranty are not tax deductible until the company pays claims. So product warranty is only allowed on the actual basis, on the paid basis. Claims paid in 7-8 amounted to 2,17,000. Claims paid in 7-8 amounted to 2,17,000. Right. So it means whatever actual claim you paid, it will be allowed to be deducted, right? But whatever provision you have taken, that will be disallowed. So provision has to be disallowed. Actual claim has to be allowed. Actual claim has to be allowed, right? Clear? Is that clear? Yeah. Okay. Okay. So now let's come to this Excel file and solve this question. I hope this Excel file was visible. That Word file was not visible. Sorry. So let me show you. The point number 6, it was showing that government grants are not taxable. Full government grant received in 7-8 is included in the balance sheet. So in the balance sheet, it is 14 lakh rupee. Okay. It is given as 14 lakh rupee in the balance sheet. Deferred government grant is given as 14 lakh rupee in the balance sheet. Okay. Now in 7-8, it is written in the point number 7. H Limited has created a provision for 1,75,000. Product warranty are not tax deductible. It is deductible on claim basis and claim paid are 2,17,000. Claims paid are 2,17,000. So first of all, provision for warranty. How much it is? 1,75,000 of provision taken, which was disallowed, and warranty claims paid. Warranty claims paid is how much? Warranty claims paid is 2,17,000. 2,17,000. Okay. Now, point number 8. During the year, H Limited introduced healthcare benefits for the employees. Healthcare benefits for the employees. During the year, H Limited introduced healthcare benefit for employees. The expenses are allowable for tax purposes only when benefits are paid but in line with Ind AS 19 recognized in profit or loss when employees provide service. When employees provide service. During the year, H Limited introduced healthcare benefit for employees. The expenses are allowable for tax purposes only when benefits are paid. But according to Ind AS 19, it has to be recognized on an accrual basis. On an accrual basis. So whether the healthcare benefit, whether it is given during the year. So basically, this company has introduced during the year. Okay. So let me see if there is anything which is given in P&L. Nothing is given in the P&L. So let's look at the balance sheet. If it has been accrued, right? So the liability must be there. The liability must be there. Okay. So the liability must be there. Yes. Medical benefits for employees, 24 lakh 50,000. It means this 24 lakh 50,000 is part of your operating cost. So this medical benefit expenses account debit to medical benefit provision account. This entry would have been passed. So this 24 lakh 50,000 rupee has been recognized in the P&L, right? So what we should do, because it has been allowed on a payable basis, but now we have taken a provision. So what we will do, we will disallow it. Provision for health benefit. And what is the provision for a health benefit? How much amount we have seen? 24 lakh 50,000. 24 lakh 50,000. Okay. 24 lakh 50,000. Is that clear? Now let's go to the next part quickly. Yes. So we have taken this adjustment of point number 8 also. Point number 9. Penalties towards violation of laws included in operating expenses amounting to 63,000. These are not deductible for tax purposes. Disallow it. Provision for penalties towards violation of laws. Penalties. So disallow these penalties. What is the value of the penalty? 63,000. Okay. 63,000 is the value of the penalty. Right. Point number 10. Tax law allows to deduct expenses for petrol only up to 1,40,000 per vehicle per year. Tax law allows to deduct expenses for petrol only up to 1,40,000 per vehicle per year. H Limited had 4 vehicles in 7/8 and its petrol expenses amounted to rupees 7,21,000. Okay, total expense is 721. There are 4 vehicles and allowable expense is 140 per vehicle. 140 per vehicle. So friends, working note 3. What should be your allowable petrol expenses for 4 vehicles? For 4 vehicles, what is your allowable petrol expenses for 4 vehicles? 1,40,000, right? Multiply by 4. So allowable is 560. What is actual expense incurred? Actual expense incurred and recorded is how much? It is 7,21,000. 7,21,000. Okay. Yes. Am I audible now? Yeah. So friends, we have captured all these 10 points in our income tax computation, and see, this is also written in the question as I told you, na? Don't apply your mind if something is specifically written in the question. It is not income tax question. It is accounting question for application of current tax. Okay. So it is also written in the note. This illustration is prepared only for the purpose of understanding the computation of current tax, right? And is in no way based on the provision for Income Tax Act. For the purpose of financial reporting, the tax treatment will be given in the question, right? So friends, now what is my taxable profit? What is my taxable profit? My taxable profit is how much? 59,50,000 was the profit as per the books of accounts. The total disallowance, is how much? 1 crore 20 lakh 47,000. The total disallowance, right? Total disallowance is 1 crore 20 lakh 47,000, and the total deductions, right? Total disallowance additions. Then total allowance deductions. Total allowance deductions oblique deductions. Okay, is how much? Now, what is my taxable profit? What is my taxable profit? My profit as per Income Tax Act, or my taxable profit will be profit as per books plus expenses disallowed minus expenses allowed. 93,80,000 will be my 93,80,000 will be my taxable profit. Now, what is the applicable tax rate? What is the applicable tax rate? Applicable tax rate 30%. What is my tax expense? Multiply by 30%. 28,14,000 is my applicable tax rate. Okay, applicable tax rate. So 28 lakh. So applicable tax rate is this much. So what is my tax expense? My current tax expense is how much? 28,14,000. What is the accounting entry? What is the accounting entry? Provision for current tax expense account debit to to current tax liability account. Current tax liability account. Okay, credit. So friends, the point is, at times you will look at the question seems to be very lengthy question. If you see this question, this question is captured into 3 pages, right? This question is captured into page number 1, page number 2, right? Then the solution is there, right? So this question is 2 complete pages question, but the solution was quite simple. If you go step by step, the solution was quite simple. Okay, and even there is a stepwise marking also. Okay, right? Is that clear? Absolutely clear, very much clear. Okay, I hope it is very much clear to all of you. Yes, yeah. Now friends, let's discuss the other concepts quickly, and then we'll again come back to a question. So we have covered this part. We have covered the concept of the current tax. Now let's come to the concept of the deferred tax. What is the concept of deferred tax? Deferred tax is something where you are going to postpone your tax liability, or you are going to prepone your tax liability. For example, you have recognized a provision for gratuity in the current year. Okay, you have recognized your provision for gratuity expense in the current year. And this provision for gratuity expense is 1 crore rupee. Income tax allows this provision for gratuity on the paid basis. So in the current year, you have a profit as per the books of accounts of 5 crore. Okay. In the 5 crore, there is a expense of provision for gratuity of 1 crore. Okay. So what is your taxable profit? Your taxable profit, while computing the taxable profit, you will take profit as per books of accounts 5 crore, and you will add your provision for gratuity by 1 crore rupee. Okay. You will add provision for gratuity by 1 crore rupee. For example, the profit as per books is how much? 5 crore. And add provision for gratuity because it is disallowed. Provision for gratuity because it will be disallowed. 1 crore rupee. Okay. My total provision is 6 crore rupee, right? So this is my total provision, not total provision, taxable profit. 6 crore rupee. Assuming tax rate is 30%. So what is my tax liability? My tax liability will be how much? 6 multiplied by 30%. 1.8 crore is my liability. For example, this is 25, 24, 25. Now let's come to 25, 26. 25, 26. In 25, 26, the company has the same profit in the books. Okay. But company does not have any gratuity. In 25, 26, company in 25, 26, company in 25, 26, the company has not recognized any gratuity expense in the books but paid rupees 1 crore to employees. Okay. Friends, tell me, the profit as per the books is 5 crore only, but here no any gratuity expense was recorded, right? And that is why I'll not add back anything, but we have paid 1 crore rupee of gratuity. So it means in the next year, this gratuity benefit will be provided. So what will be my expense in the next year? What will be my taxable profit in the next year? My taxable profit will be 4 crore. What will be my tax expense? It is 1.2 crore. So friends, the point is, see, I am getting a benefit of this provision for gratuity. I am getting a benefit in 25, 26, the expense which I have already recorded in 24, 25. Means what I have done? I have preponed my tax liability. If you look at, I have paid how much tax extra? If this addition would not have been there, what would have been my tax? Let's say if this addition would not have been there, on the book profit, my tax would have been 30%, 1.5. But how much I have paid? I have paid 1.8. So how much extra I have paid? So tax on the basis of book profit, right? But how much excess I have paid? How much excess I have paid? I have paid 0.3 crore, 30 lakh rupee of extra tax. So I have preponed my tax liability. I paid 30 lakh rupee of extra tax. What happened in the next year? In the next year, if I would have paid the tax on the basis of book profit, it would have been 1.5 crore. But how much? How much less I have paid? How much less I have paid? Benefit I have received. How much benefit I have received? I have paid 1.2. Ideally, it should have been 1.5. 30 lakh rupee benefit I have received. So friends, it means I have already preponed my tax liability. It means I will receive the benefit in future. It means I have created a deferred tax asset. Okay. So what is a deferred tax? Deferred tax means either deferring your tax liability or either deferring your savings in the future. Either deferring your liability or either deferring your savings for the future. Okay. Here I have deferred my savings, means I will have saving in the future, right? So when you will have a savings in the future, it is known as a deferred tax asset. When you have a liability in the future, it will be known as a deferred tax liability. Is that clear to everyone? Is that clear to everyone, my dear friends? Yes or no? Is that clear? Okay. Very good. So deferred tax means you are doing some adjustment in the books of accounts in the current year, right? That either you will have a future savings of the taxes or you will have a future liability of the taxes. Okay. Right. Right. Great. So now let's discuss the deferred tax concepts and we'll do some questions on the deferred tax. Deferred tax is tax payable or recoverable in future periods. Like The recent example which we have taken is a tax recoverable in the future period, and the another example could be tax payable in the future period also, which I will going to take. Some points to remember about deferred tax asset or deferred tax liability. Okay. So first of all, your deferred tax asset and deferred tax liability shall never be discounted. DTA, DTL shall never be discounted. For example, you have created a deferred tax liability or you have created a deferred tax asset, and you know that these deferred tax asset and deferred tax liability are going to be reversed after 5 years. Okay. You estimate that these are going to be reversed after 5 years. Now the point is, if this DT and DTL is going to be reversed after 5 years, whether you will discount this DT and DTL, answer is no. So DT and DTL are never going to be discounted, prohibited. These are prohibited to be discounted. So DT and DTL will never be discounted. Okay. Number 2, another question. Friends, for example, you all are chartered accountants. Okay. You went for the audit of a company, right? And it's a private limited company. On 31st March 2026, on 31st March 2026, the company has created a deferred tax asset of 20 lakh.
Yes.
The company got a huge order and the company has got a windfall profit. The company has got the huge order and the company has got the windfall profit. The company has got the windfall profit. Okay. The company has got the windfall profit. Right? Friends. Now my question to all of you. As an auditor, you know that whatever deferred tax asset I have recognized on the losses in this 31st March, para 56 of Ind AS 1 says that DT and DTL shall always be a non-current asset or non-current liability. DT and DTL shall always be a non-current asset and non-current liability. And if you will see the Schedule 3 format, division 2 to Schedule 3 format of balance sheet, you will found that DT and DTL is only shown in the non-current asset and non-current liability. There is no DT and DTL in the current asset and current liability section. Okay. Is that clear? I hope it is clear. Yes. Now, deferred tax has to be computed on the balance sheet approach. Deferred tax has to be computed on the balance sheet approach. Sir, what is this balance sheet approach? Friends, in our accounting standard, we were following the P&L approach. But here, the deferred tax balance sheet approach means you have to compare your balances in the balance sheet as per books of accounts, right? When you prepare your balance sheet, what are the balances of assets and liabilities in the books of accounts versus if you would have prepared the balance sheet as per Income Tax Act provisions, what would have been the balance sheet balances? So basically, when you prepare your balance sheet value, and if you would have prepared the balance sheet as per income tax provision, what are the balance sheet balances of assets and liability? This is known as a tax base. You need to compare book base and you need to compare tax base. Okay. So whenever this book base and tax base is different, then there is a deferred tax implications. Okay. So deferred tax asset has to be computed on the balance sheet approach and deferred tax has to be computed on the temporary differences. The word is temporary differences in Ind AS, not the timing differences. In accounting standard, the word is timing differences, but in Ind AS, the word is temporary differences. Okay. So deferred tax has to be computed on the basis of temporary differences. Okay. So let's understand this balance sheet approach and temporary differences with the help of an example. Okay. So for example, property, plant and equipment, PP&E. Okay. Property, plant and equipment. The balance sheet as per Ind AS, the property, plant and equipment is 1 lakh. And the balance sheet as per Income Tax Act. So basically, on 1st April 2025, the company has purchased a machinery. The company has purchased a PP. What is the accounting entry as per Ind AS? So PP account debit to bank account. Yes. यही अकाउंटिंग एंट्री होगी ना, पीपी अकाउंट डेबिट टू बैंक या कुछ और होगी? पीपी अकाउंट डेबिट टू बैंक 1 लाख रुपी 1 लाख रुपी, पीपी अकाउंट डेबिट टू बैंक 1 लाख 1 लाख. PP account debit to bank 1 lakh, 1 lakh. Okay. Friends, this is H per Ind AS, right? H per books. If income tax, if income tax, if income tax officer, H per income tax provision, or you will pass the entry H per income tax provision, what will be the accounting entry for purchasing a fixed asset? Same entry. Same entry will be H per income tax also. Same entry will be H per income tax also, right? सेम ही एंट्री होगी ना इनकम टैक्स में भी. PP account debit to bank. So the tax base and book base, the tax base and book base will be same. The tax base and book base will be same in income tax and Ind AS on the date of initial recognition. On the date of initial recognition. Now, at the end of the year, this PP, this machinery is going to be depreciated. So under Ind AS, the depreciation has to be provided on the basis of, this is known as a book base or carrying value. This is known as a tax base. Okay. This is known as a tax base. Okay. Right. This is known as a book base. This is known as a tax base. I do. We compare the PP balance in the balance sheet versus the PP balance H per income tax balance sheet, right? Book base of PP versus tax base of PPE. This is what we are comparing, right? But what we used to do in our accounting standard in IGAP, we used provisions, H per income tax provisions. Okay. So if you see, the difference is same. The difference is same. 5,000 rupees the difference. Okay. Approach in P&L, sorry, in IGAP, it is a P&L approach. Okay. So this is a balance sheet approach. Friends, this is a revisionary class. We will be completing this Ind AS 12 in one class. Okay. While if you look at the live virtual session, which was the full class, so this Ind AS 12 was covered in 2 classes of 6 hours. Okay. But since it is a revisionary class, right, and hence institute has given the one class the 50% time for the revision. Okay. Ideally, in the revision, the time has to be 30 to 40%. Okay. Maximum 30% to 25%. Yes, let's discuss with the help of this example, then we'll go to the complex questions. A Limited has purchased a machinery for rupees 1 lakh on 1st April 2023. The useful life of the machinery is 10 years. So 1 lakh rupees the cost, 1st April 23, useful life is 10 years, depreciation as per books is 10,000. In income tax, depreciation on machinery is provided at 15%. In income tax, depreciation on machinery is provided at 15%. So in the first year, the depreciation is 15,000. Please provide current tax and deferred tax calculation for FY 23-24, assuming the profit before depreciation is 50,000. Tax rate is 30%. So what is my accounting profit? My profit before depreciation is 50,000. Depreciation expense is 10,000. My profit before tax is 40,000, right? Now I need to do a income tax computation, right? I need to make a charge of, I need to make a charge of what? I need to make a charge of current tax and deferred tax, and then I need to compute my profit after tax. So what is my current tax and deferred tax? So let's compute the current tax first. My profit before depreciation is 50,000. Okay. So this is profit before depreciation, means in this 50,000, that books depreciation is not there. So what you will do? You will claim tax depreciation. So depreciation expenses H per income tax. H per income tax. So depreciation expense H per income tax. Okay. It is what? 15,000. It is 15,000 and 1 lakh multiplied by 15%. It is given. Okay. 10,500 will be your current tax expense. Now, what is your deferred tax expense? Right. What is your deferred tax expense? So alternatively, your profit as per books is 40,000. You will add back your depreciation as per books. You will reduce your depreciation as per IT Act. You will get a taxable income of 35,000, tax of 30%, 10,500. Let's go by the balance sheet approach. Okay. 1 lakh, depreciation is 10,000. 90,000 is your carrying amount, which is also known as a book base, right? Now, balance sheet as per income tax provisions. Your gross block is 1 lakh. Your depreciation is 15,000. Your tax base is 85,000. So my carrying amount is 90,000. My tax base is a temporary difference is 5,000. My tax rate is 30% and my deferred tax is 1500. My deferred tax is 1500. Now friends, how will you identify? So your carrying amount is 90, your tax. But sir, whether this will be a deferred tax asset or deferred tax liability, whether it will be a deferred tax asset or deferred tax liability, how will you quickly identify that? Let me again recap the hand trick. Hand trick. आपने आपने वो हैंड ट्रिक, आपको हैंड ट्रिक पता है ना, आपको हैंड ट्रिक, राइट? आर यू अवेयर अबाउट दिस हैंड ट्रिक और नॉट? यस, hand trick of identifying DTA and DTL, hand trick of identifying DTA and DTL. Yes, do you remember this hand trick? No, so let me quickly tell you the hand trick. Okay, on the one hand, doesn't matter left or right, wherever you want. Let's say, so I have keep the balance sheet as per books, as per Ind AS, and the carrying amount I have kept in my left hand. Okay, you can keep in any hand. So on one hand, my books are there. My balance sheet as per books is there. My balance sheet as per Companies Act, Ind AS, right, is there. On the another hand, my tax books are there. So my company's books, in my company's books, my asset balance is 90,000. In my tax books, my asset balance is 85,000, lower than company's books, right? Now, friends, what is the purpose of deferred tax? The purpose of deferred tax is to align the company's books with income tax books, right? Right. So by passing the adjustment of deferred tax. So now, my dear friends, my book base is 90,000. My tax base is 85,000. I need to align my books with tax. So where I need to pass the accounting entry, in my income tax books or in my tax in my company's books? I need to pass the adjustment in my company's books. Income tax books are lying with the income tax officer. So my company's books are lying with the company. So I need to pass the adjustment in my company's books. So if I need to pass the adjustment in company's books, I have to reduce my asset. When I say I have to reduce my asset to align with the income tax asset, so if I need to reduce my asset, what does it mean? I need to create a liability. I need to create a liability. So friends, that is why in this case, it will be a deferred tax liability. It will be leading to a deferred tax liability. Okay. Or vice versa. If you have to apply your mind in detail, so friends, your carrying amount is 90,000. Okay. Your tax base is 85,000. It means why your income tax balance is lower? It means you have taken additional benefit. If you have taken additional benefit today, tomorrow you are going to take a lower benefit. Means tomorrow you will have a liability. As simple as that. Tomorrow you will have a liability. As simple as that. Okay. As simple as that. Tomorrow you will have a liability. Okay. Is that clear, friends? Okay. Right. Let's go to the steps of deferred tax. Let's go to the steps of deferred tax. So I hope this hand trick is clear to all of you. Is that clear? Not clear? Please tell me. क्लियर हुआ नहीं हुआ? बताइए प्लीज. ये आप लोगों को क्लियर है? यस, और इट इज नॉट क्लियर? या, I hope it is clear. Okay, so let's quickly discuss this part. Friends, what are the steps of the deferred tax? First step, compute the carrying amount, which is also known as book base, right? Compute the carrying amount of assets and liability, which is also known as book base, right? Book base means company's books, balances as per company's books. Compute tax base of assets and liabilities, right? Applying the income tax provisions. If you will prepare the balance sheet as per income tax provision, what will be your asset and liability balances? Then compute temporary differences. Compute temporary differences, right? And friends, the temporary differences could be taxable temporary differences and it could be deductible temporary differences, right? So if there is a deferred tax liability, means there is a liability in future, it means there is a taxable temporary differences, means it is going to be taxable in future. It means it is going to be It is going to be create a liability in future, tax liability in future. So taxable temporary differences means deferred tax liability. Taxable temporary differences creates a deferred tax liability. Deductible temporary differences create a deferred tax asset. Deductible temporary differences means this temporary differences is going to be deductible in future. So this temporary differences is going to save tax in future. So you can identify whether it is a taxable temporary differences or it is a deductible temporary differences using the hand trick to identify DTA or DTL. Then you need to determine the tax rate, and then you need to calculate and recognize deferred tax asset or deferred tax liability. You need to calculate and recognize DTA and DTL. DTA and DTL. Friends, let's do a question number 3 from this word file, and let's discuss the nuances of deferred tax. Okay, let's discuss this question number 3, deferred tax. I hope this word file is visible to everyone. Is it visible to everyone or not? Please tell me. Okay. K Limited prepare consolidated financial statements to 31st March each year. K Limited prepares consolidated financial statement to 31st March each year. Okay. To each year. During the year ended 31st March 20x2, K Limited entered into the following transactions. On 1st April, K Limited purchased an equity investment. K Limited purchased an equity investment for rupees 2 lakh. The investment was designated as fair value through other comprehensive income. The investment was designated as FVT OCI. On 31st March, after 1 year, the fair value of the investment was 2,40,000. So cost of the investment was 2 lakh. The fair value of the investment was 2,40,000. In the tax jurisdiction in which K Limited operates, unrealized gains and losses arising on revaluation of investment of this nature are not taxable unless the investment is sold. So this kind of, unrealized mark to market gains and losses, these are not taxable. The taxability arises when these investments are sold. K Limited has no intention of selling the investment in the foreseeable future. K Limited has no intention of selling the investment in the foreseeable future. Okay. In the foreseeable future. Okay. So friends, the question is asking, explain and show how the tax consequences, current tax and deferred tax of the 3 transactions. We have only read the first transaction. So I want to read what is the ask of the question. The ask of the question is to provide the current and deferred tax implications, right, which has to be reported in the statement of P&L and other comprehensive income for the year ended 31st March X2. Assume tax rate is 25%. Assume tax rate is 25%. Friends, in this case, since you are aware that P&L has 2 parts, okay? You know ना P&L has 2 parts. आपको पता है ना ये वाली बात कि P&L के 2 पार्ट होते हैं. सर कौन से 2 पार्ट होते हैं P&L के? सर which 2 parts P&L has? So statement of P&L has statement of P&L. The first part is that which provides you PAT, and the second part is OCI, right? OCI. The items relating to the first part, the tax, the current tax, deferred tax. So current tax will always be in the PAT, always be in the first part of the P&L, and deferred tax relating to the normal items, right, has to be taken in the first part for arriving at PAT. But items relating to OCI, deferred tax has to be taken in the OCI for the item relating to OCI. Okay. So friends, in this case, the investment was purchased, investment was taken as FVT OCI, mark to market gain of 40,000 was recorded in OCI, 25% is the tax rate, 25% is the tax rate. So talking about the current tax, there is no consequences of current tax. There is no consequences of current tax. Why? Because this current tax is applicable only at the time of sale. Okay. So there will not be any current tax on this 40,000 rupees of gain, there will not be any current tax. But what about deferred tax? What about deferred tax, my dear friends? So first of all, you need to compute your book base. What is your book base? What is the carrying value? 2,40,000 in the books of accounts. So your book base is 2,40,000. What is your tax base? Your tax base is 2 lakh only. Why? Because tax ignores this unrealized mark to market gains and losses. Tax says that I don't know what is this mark to market gains and losses. I will record the gain and loss only when I will realize. So in the book base, in the carrying amount 2,40,000 of investment, in the tax base 2 lakh rupee of investment, tax base is 2 lakh rupee. So what should I do? I should reduce my asset balance. Means which asset balance? Not investment. I should reduce my asset balance means I need to create a liability. I need to reverse my asset means what is meant by reversal of asset? Creation of liability. Right? Negative asset is equal to liability na. So I need to create a deferred tax liability. Deferred tax liability of what amount? 40,000 multiplied by 25%, 10,000 rupees of DTL will be there. So this deferred tax expense has to be recognized in OCI. Credit will be deferred tax liability. So let's read this. Because the unrealized gain, right? Unrealized gain, just a minute. I hope this word file is visible. Yes. Because the unrealized gain on revaluation of the equity investment is not taxable until sold, there are no current tax consequences. The tax base of the investment is 2 lakh. The revaluation creates a taxable temporary difference of 40,000. 240 minus 2 lakh means we recognize a gain of 40,000 today, but we are going to pay tax when it is sold at profit. Okay. This creates a deferred tax liability of 10,000 rupees. The liability would be non-current. The fact that there is no intention to dispose of the investment does not affect the accounting treatment. Because the unrealized gain is reported in other comprehensive income, the related deferred tax expense is also reported in other comprehensive income, right? Other comprehensive income. Now, the second part. On 1st August 2001, K Limited sold product to A Limited, a wholly owned subsidiary operating in the same tax jurisdiction as K Limited for rupees 80,000. Right? So K Limited sold product to A Limited, a wholly owned subsidiary operating in the same tax jurisdiction as K Limited for rupees 80,000. So K Limited sold goods to A Limited for rupees 80,000. Okay. The goods had cost to K Limited for 64,000. K Limited had sold goods to A Limited for rupees 80,000. The goods had cost to K Limited for 64,000 means there is a 16,000 rupees of profit. By 31st March 2002, A Limited has sold 40% of these goods, selling the remaining during next year. Okay. So friends, this you remember this question is about consolidation. And this K Limited sold the product to A Limited. And K Limited has generated a profit of 16,080 minus 64, right? So from the group perspective, so there is a current tax liability. If I talk about K Limited, so K Limited has sold goods for 80,000 rupees, right? The sales price is in the standalone books of K Limited, sale price is 80 and cost is 64. What is my profit? 16,000 is my profit. And the current tax is how much? Current tax is how much? By 16,000 multiplied by 25%. 4,000 is my current tax. 4,000 is my current tax, right? So for the group and for the standalone entity, total profit arise in the group is 16,000 rupees, right? So 16,000 rupees multiplied by 25% is the tax. Okay. So friends, but what about in the consolidated financial statement? In the consolidated financial statement, what is my carrying value of the unsold inventory? If I talking about the consolidated financial statement, आपके कंसोल में क्या होगा? What happened in your consolidated financial statement? So in your CFS, right? CFS is the group as a whole, group as a single entity. If you talk about group as a single entity, what happened here? 64,000 was the cost. 64,000 was the cost, right? Sale price was 80,000 was the sale price. Okay. And and how much goods are sold by A Limited to the third parties? How much goods are outside the group? How much goods are gone outside the group? 40% of the goods have been sold already. So 40% of the goods have already been sold. Means if I talk about the cost, how much cost of the goods are sitting here? 64,000 multiplied by 60%, right? Which is how much? 60 multiplied by 60%, 36,000, 4 multiplied by 60, 2,400, 38,400. 38,400 rupees of goods are sitting in the group, right? And and since from income tax perspective, income tax says that you have actually sold the goods to your subsidiary, we will consider the tax base. What is the tax base of the unsold inventory? So income tax says that I don't know what is your consolidation adjustment. I don't know. You have sold goods for 80,000 rupees, and 80,000 rupees multiply by 60%. 48,000 rupees worth of goods are there in your inventory. So income tax talks about 48,000 rupees of inventory, and the consolidated books talks about 38,400 rupees of inventory. So the difference between 48 and 38,400, 9,600. What should we do? We should create a deferred tax liability. 9,600 multiplied by 25%. We should create a what? What? Sorry, my bad. In the books of accounts, it is 38,400. In income tax, it is 48,000, right? So we should increase our asset. So what we should do? We should create a deferred tax asset. Okay. We should create a deferred tax asset. Is that clear or not clear? भाई इनकम टैक्स तो वही मानेगा ना कि भाई आपने गुड्स बेच दिए, तो मैं तो उस गुड्स की फेयर वैल्यू को वैल्यू मानूंगा. ओके, राइट. बट इन द कंसोलिडेटेड बुक्स व्हाट यू डू, whatever unrealized profit is there, you should eliminate that profit. Okay. So in the standalone books of K Limited, there is a current tax liability of 4,000 rupees. So income tax has recognized that you have sold it. But in the consolidated books, the cost of the inventory is 38,400. But from the income tax perspective, it is 48,000 rupees. Okay. Yes. Clear? Third part. On 31st October 2001, K Limited received 2 lakh rupee from a customer. This payment was in respect of service to be provided by K Limited from 1st November to 31st July 20x2. We are talking about the transactions for 31st March 2002. So it means K Limited has received an advance of 2 lakh rupee. The period is 1st November to 31st July. Okay. Means part period is in the current year and part period is in the next year. K Limited recognized revenue of 1,20,000 in respect of the transaction in the year ended 31st March 2002 and will recognize the remainder in the year ended 31st March 2003. So 80,000 revenue pertains to the next year. 1,20,000 revenue pertains to this year, while the entire money has been received in advance. Under tax jurisdiction in which K Limited operate, 2 lakh rupee received on 31st October was included in the taxable profit of K Limited for the year ended 31st March 20x2. So income tax provision says that in the period in which you receive the money from the customer, right? So the taxable profit, so for the purpose of tax, that money will be included in that year itself. So friends, first of all, tell me in the book base, in the company's books, you have received an advance of 2 lakh rupee. You recognize a revenue of 120. So what is the remaining advance lying in the books on 31st March? 80,000 rupees. 80,000 rupees of deferred revenue is lying in the books as a liability. But under income tax, is there any liability? Income tax has already recognized the entire 2 lakh rupee as a revenue. Like out of 2 lakh, you have also recognized 1,20,000 in your in your books of accounts. So you are showing a liability. You are showing a book base of 80,000 only. In the tax base, it is 0. So what should you do? You have already paid the tax. Okay. You have already paid the tax. Means you will create a deferred tax asset. Going by the hand trick, The liability is 80,000 in the book base, in the books of accounts. In the textbooks, the liability is 0. We have to reduce it. We have to reverse our liability, means we have to create an asset. So asset has to be recognized. So friends, the receipt of revenue in advance on 1st October would create a current tax liability of 50,000, right? 2 lakh multiplied by 25%, you have paid tax. The carrying value of the revenue received in advance at 31st March 2 is 80,000. Tax base is 0. So it is a deductible temporary differences of 80,000 would create a deferred tax asset of 20,000. 80,000 multiplied by 25%. The asset can be recognized because K Limited has sufficient taxable profit against which to utilize the deductible temporary differences. Okay. Is that clear? Is that clear, my dear friends? Great. Friends, it's 8:34 now. Let's have a break and we will start at 8:46. Okay? 11-minute break.
So friends, we discussed about this three, situation of deferred tax and current tax, right? Three situations of deferred tax largely. If through the question number 3, right? Now let's go to the concept again, and we'll discuss. Just a minute. Yes. Yeah. And friends, with this comprehensive example, we'll do practice of deferred tax asset. See, the concept, if I talk about the question on current tax and deferred tax, the question may be lengthy, right? The question may involve a lot of situations, but if you apply your mind with calm and patience, you will be able to crack every question on current tax and deferred tax. That's the key. Okay. So it requires more and more practice. It requires more and more practice. The approach is the balance sheet approach. First, you need to identify what is book base. Book base means carrying amount. Carrying amount means amount which is there in the balance sheet as per Ind AS, as per Companies Act. Okay. Right? Then tax base. Tax base is very simple. If this transaction, if this accounting has to happen, if this accounting has to happen as per the provisions of income tax, as per the provisions of income tax, then what is the balance, right? अगर ये बैलेंस शीट इनकम टैक्स प्रोविजन के हिसाब से बनाई जाती तो एसेट लायबिलिटी का बैलेंस क्या होता, उस आइटम का बैलेंस क्या होता, what would have been the balance of that item, that assets and liability in the balance sheet if this balance sheet would have prepared as per income tax provision. That is known as a tax base. The two differences are, the difference between book base and the tax base is known as a temporary difference. This temporary difference could be taxable temporary differences. It could be a deductible temporary differences. If it is a taxable temporary differences, it is a deferred tax liability. If it is a deductible temporary differences, it is a deferred tax asset. You need to apply tax rate on the temporary difference. It will give you deferred tax asset or deferred tax liability. Okay. So for example, ABC Limited, let's update this example. So ABC Limited has following transactions in place for financial year 25-26. Okay. Compute the carrying amount, tax base, type of temporary differences, DTA, DTL, etc. for the books of accounts ended on 31st March 2026. So everything is asking in the question. This question has asked everything. Okay. Point number A. The company has invested 8 lakh rupee in mutual fund during the current year. The fair value on the reporting date is 8.5 lakhs. Friends, your income tax ignores this fair valuation. Okay. So, but in the books of accounts, as per Indian accounting standard, these financial asset has to be measured at fair value. So the cost is 8 lakh. The fair value is 8.5 lakh. So what is the book base? What is the carrying amount in the books of accounts? 8.5 lakh. And what is this? This is an asset. What is the tax base? Tax base is 8 lakh. Tax base is 8 lakh. It means, what is my temporary difference? My temporary difference is 50,000. Is it a taxable or deductible temporary differences? Right? I need to reduce my asset. It means I need to create a liability. If I need to create a liability, it is a taxable temporary differences. It is a taxable temporary differences. Okay. So friends, mutual fund. What is a mutual fund? Mutual fund is an asset. Mutual fund is an asset. Okay. So carrying amount of the mutual fund is 8.5 lakh. Tax base is 8 lakh. It is a taxable temporary differences. Okay. And the amount of temporary difference is 50,000. 8.5 minus 8. Right. This is taxable temporary differences. Tax rate is assuming 32%, which is given in the question. So basically, tax rate is 30%. However, the government has announced a tax rate of 32% for the future year before 31st March. My dear friends, if government has enacted a new rate before or as on the end of the reporting date, so your deferred tax calculation will be happen on the future rate. Okay. But it has to be enacted. It has to be enacted as on or before reporting date. It has to be enacted on or before reporting date. Right? tax rate is 30%. However, the government has announced a tax rate of 32% for the future year before 31st March, right? So 32% is okay. So 50,000 multiplied by 32%, it comes out at 16,000. So this is my deferred tax liability. This is my deferred tax liability. Second, the value of the machinery purchase is 1 lakh in the beginning of the year. So 1 lakh rupee. Okay. Life is 10 year. In income tax depreciation is WDV 20%. So at the end of the first year, what is my carrying amount? My carrying amount is 1 lakh minus 10,000. 90,000 is my carrying amount. What is my income tax base? What is my tax base of this machinery? My tax base of the machinery is 1 lakh minus 20,000, 80,000. Okay. So my carrying amount is in the books is 90,000. My tax base is 80,000. It means I need to reduce my asset. If I need to reduce my asset means I need to create a liability, means it is a taxable temporary difference. Okay. So machinery, it is an asset. Machinery is an asset. Okay. Carrying amount is 90,000. Tax base is 80,000. It is a taxable temporary differences. Temporary difference is 10,000. Tax rate is 32%. And it will also create a DTL of 3,200. Okay. Now, friends, next question. The income received in advance from customer for rupees 50,000. In Income Tax Act, income is taxable in the year of receipt. So income received in advance for 50,000. What is the accounting entry in the books of accounts? Bank account debit to deferred revenue or advance from customer. Bank account debit to advance from customer liability account. No revenue has been recognized. In Income Tax Act, entire revenue has been recognized. So bank account debit to advance from customer, then advance from customer debit to revenue or bank to revenue. As simple as that. So this is a liability as per books of accounts. This is a liability of 50,000 rupees advance from customer. As per tax base, zero, liability is zero. So I need to reduce my liability to align with the tax, right? So if I need to reduce my liability means I need to create an asset, means there is a deductible temporary difference. Okay. There is a deductible temporary difference. So advance from customer or unearned revenue, liability is 50,000 in the carrying value. The carrying value of the liability is 50,000. Zero tax base, deductible temporary differences of 50,000 rupees. It is a DTA and it is how much? 50,000 multiplied by 32%. Okay. Then the company has created a provision for gratuity for rupees 1 lakh during the year, and Income Tax Act, this is allowed only on the payment basis. So company has a provision for gratuity of 1 lakh rupee liability. In income tax says that I will create gratuity only in my books of accounts when you will pay it. So in Income Tax Act, it is zero. So book base is 1 lakh, tax base is zero. I need to reduce my liability, means create an asset, means deductible temporary difference. Okay. Very simple. Provision for gratuity 1 lakh, tax base zero, deductible temporary difference is 1 lakh, 32% is the tax rate. It is DTA, 32,000 rupees of DTA. Friends, it is a revisionary session and you have to be very fast with this hand tricks. Okay. There is an interest receivable of 10,000 on one of the deposits. The related interest revenue will be taxed on a cash basis. So in one of the deposit, so there is an interest receivable. What accounting entry has been passed? The accounting entry has been passed is fixed deposit account debit to interest revenue account. You need to record the revenue on accrual basis, right? So you recorded the revenue of 10,000 rupees. You recorded the interest of 10,000 rupees on accrual basis, right? You debited your FD, you credited your interest receivable, or vice versa, or not a vice versa. Alternatively, what you can do, you can create an interest receivable asset debit to interest income account. Okay. Interest receivable asset to interest income. Income Tax Act says that I don't know accrual accounting. I will record this interest income when you will receive the interest on cash basis, right? So interest receivable asset 10,000 rupees is lying in the books of accounts. carrying value. Tax base is 0. Now, to align, you need to reduce your asset. You need to reduce your asset means you need to reduce your asset means you need to create a liability means taxable temporary differences. Okay. Taxable temporary difference. Okay. Right. So 10,000 rupee is the carrying amount. 0 is tax base, taxable temporary difference of 10,000. 32% is tax rate. It will be DTL 3200. Okay. 3200. Right. Next, the company has incurred preliminary expenses for rupees 1 lakh during the year. In income tax, 1/5 deduction will be allowed in every year. Friends, this preliminary expenses is not required to be deferred in the books of accounts. So whenever you incur preliminary expenses, it has to be expensed off in the same year in the books of accounts. So in the books of accounts, the preliminary expenses balance will never come into the balance sheet. So what is your book base? 0. What is your tax base? So the company has incurred preliminary expenses of 1 lakh. In the tax, every year 20,000 deduction is allowed. Means in Income Tax Act, this preliminary expenses has been created as an asset with a carrying value of 80,000 rupees. So in book base, it is 0. In tax base, it is 80,000. So what should we do? We have to increase our asset. We have to increase our asset. When we have to increase our asset means it is a DTA. It is a DTA, right? So preliminary expenses is an asset, okay, right? And the carrying amount is 0. Tax base is 80,000. It is a deductible temporary differences. 80,000 is a temporary difference. 32% is tax rate. It will be DTA, and this will be your deferred tax asset, 25,600. Okay. Now, my dear friends, next, current liabilities include accrued expenses with a carrying amount of 5,000. The related expense will be deducted for tax purposes on a cash basis. The company has created a liability on accrual basis. On accrual basis, the company has created a liability. So company has passed an accounting entry, expenses account debit to accrued expenses account. And this liability was carrying in the books of accounts for 5,000 rupees liability. But in tax base, in tax books, tax says that I don't know accrual concept. I will recognize this only when I will pay the cash. So in tax books, this liability is 0. In the books, this liability is 5,000. So what should we do? We should reduce the liability. Means we should create some asset to align this book and tax, right? So if we need to create an asset means deductible temporary difference, right? What is the carrying amount of the liability in the books? 5,000 rupees. Tax base is 0. Okay. It is a deductible temporary difference. Okay. DTA will be created for 1,600 rupees. Right? The trade receivable was recorded during the year for rupees 40,000. The company has created a provision for doubtful debt of 5,000 on one of the debtor. So 40,000 was a trade receivable. In book base and tax base, both it is 40,000, but a provision was created of 5,000 rupees over the bad debts. In income tax, this provision for doubtful debt is not allowed. The actual bad debt is allowed. So again, if I talk about this trade receivable net balance, so in the books, it is coming at 35,000. In the tax books, it is 40,000. So what should I do? I need to increase my asset. I need to pass the adjustment entry in the books of accounts, right? I need to increase my asset, means DTA, deductible temporary difference. Yes. So trade receivable. This trade receivable is 35,000 in the books carrying amount, 40,000 in the tax, deductible temporary difference of 5,000 rupees, 32% is tax rate, DTA will be recognized for 1,600 rupees. Okay. I hope with this revision of the example, this example I have taken in my full video on Ind AS 12 also, but with this revision, you will be able to understand it in detail, right? Okay. So friends, if I talk about my balance sheet extract, this DT and DTL. So on few item there is a DT and on few item there is a DTL. So what is total DT and DTL? What is the total DT and DTL? DTA, DTL. So DTA is 16,000 plus 32,000 plus 25,600 plus 1,600 plus 1,600. What is my DTL? 16,000 plus 3,200 plus 3,200, right? This is my DTL. Okay. So whether we will show in the balance sheet, whether we will show DTA, DTL separately, or we will show it after offsetting, or we will show it after offsetting. We will show DT and DTL after netting off, after offsetting, right? What is my net? My net is DTA. 54,400 will be my DTA. So this 54,400 will be shown under non-current asset as a deferred tax asset, 54,400. And my dear friends, in the notes to accounts, you have to extract, you have to disclose this DTA DTL item wise. So notes to accounts, extract of disclosure of DTA and DTL. So what you are required to disclose in the notes to accounts? Items on which DTA is there, deductible temporary differences. You have to put all the item. What is the carrying amount? What is the tax base, temporary differences, and whether DTA or DTL. So total DTA. Then you have to put the item on which DTL is there, taxable temporary difference. Okay, like mutual fund, machinery, interest receivable, which is there. So this is your DTL total. Net is your DTA. This is part of your disclosure in the notes to accounts. You have to give an item wise breakup of DTA and DTL with the carrying amount and the tax base and the temporary difference. Okay. I hope with this example, you have had a complete revision of DTA and DTL, right? Including their steps, Okay. So friends, now before getting into the complex questions, before getting into a complex question on DTA, DTL, let's discuss some specific cases. Then we solve a question from the word file. Specific cases. Deferred tax treatment in case of permanent difference. Okay. For example, the company is liable to pay a penalty. Okay. The company is liable to pay a penalty for some contractual breaches, for some non-compliances of the government regulations. And the company has got a demand order, and the company created a provision for penalty for rupees 1 crore, right? And company has debited this expense in the books of accounts. Penalty expense account debit to penalty payable account. This penalty payable is coming into the liability side. Okay. This penalty payable is coming on the liability side. Now, my dear friends, if I talk about this penalty payable, okay, so this penalty is not allowed in Income Tax Act. Means this penalty is neither allowed on accrual basis nor allowed on cash basis, right? This penalty will never be allowed. Means the company will never be, so the company will have a hit in the P&L because the company has recorded the expense, but the company will never get the credit, never will get the benefit of this expense in the Income Tax Act, right? The company will never get the benefit while computing tax liability. So while computing the tax liability in the taxable profit, this penalty will not be deducted. So this is a permanent difference, right? So in your books of accounts, penalty payable is 1 crore rupee. But in your Income Tax Act, it says that please pay the penalty. Penalty payable is 1 crore only, right? Right. So both the act will pass an accounting entry, penalty expense to penalty payable. But of course, Income Tax Act will not give the benefit of this penalty expense. So whenever there is a permanent difference, DTA, DTL, no DTA, DTL has to be created in case of permanent difference. For example, Income Tax Department imposed a penalty on ABC for 10 lakh during FY 24-25. The penalty is payable as on 31st March 25 and the company has recognized the same in the books of accounts. In tax, the penalty will never be allowed. So carrying amount of penalty is 10 lakh. Since it is a permanent difference, DTA, DTL will not be created, right? So always remember, if there is a permanent difference, DTA, DTL will not be created. Unused tax losses and tax credits. The company has a carry forward tax losses or carry forward tax credits. Unused tax losses and tax credits. Okay. So DTA has to be recognized on unused tax losses or unused tax credits when it is probable that future taxable profit will be available against which such losses can be utilized. If the company has a carry forward losses, the company can create a deferred tax asset on such losses only when it is probable that the future taxable profit will be available against which such losses can be utilized, okay, right? Clear, my dear friends? For example, the company has a taxable loss of rupees 10 crore in FY 24-25. The company is probable that it will be able to generate taxable profit in FY 25-26 for rupees 4 crore. What is the taxable loss? 10 crore. And company is probable that it will be able to generate taxable profit in next year for 4 crore. From FY 26-27, the company will go into a tax holiday period of 10 years. Considering company is operating into a gift city of Gujarat, where government has given a tax holiday for 10 years to be opted by the company. Friends, company has a 10 crore of losses. These losses can be carried forward and set off only in the next 8 years. So at the end of 31st March 25, company has a carry forward loss of 10 crore. In the next year, the company is foreseeing a profit of 4 crore only. From the next year for 10 years, the company is going to the tax holiday. So whether in the tax holiday period, company is able to utilize these tax losses? Answer is no, because no tax has to be paid, right? So tax rate is 30%. Advise the treatment of deferred tax in the books of the company for 24-25. In this case, the company will be able to utilize the loss of 4 crore in the next year. In tax holiday period, there will not be any taxes and hence no question of utilization will arise. The remaining unused carry forward tax loss will lapse. Okay. Hence, DTA will be recognized only to the extent the company is probable to utilize. So what is my deferred tax asset? 4 crore multiplied by 30%, which is 1.2 crore. So DTA has to be recognized only to the extent of 1.2 crores. Okay. Next, friends, now the companies are doing some, what is the difference between tax planning and tax evasion? What is the difference between tax planning and tax evasion? The outcome of both are same, but the approach is different. Tax planning means you are planning your tax in such a manner, you are strategizing your tax in such a manner that you end up paying less taxes, or you end up having a savings in the taxes. That is known as a tax planning. What is tax evasion? Tax evasion means by false measures you are evading your tax liabilities. Okay. In both the cases you end up saving taxes, but tax evasion is a crime and tax planning means you are using the framework and the provision of income taxes and you are planning in such a manner that you end up paying less taxes. For example, so a person has a salary income of 10 lakh rupee. Okay. So there is a section 80C. If you are into the old provision, section 80C permits you to have a deduction of 1.5 lakh rupee, right? If you have provident fund, if you have if you are investing in the provident fund, right? PPF, PF, LIC, insurance. Okay, so those deductions are there in 80C. So you want to save taxes. So going by the tax planning, what you will do? You will do your investment of 1.5 lakh rupee in the tax saving instruments and you will end up saving a taxes on 1.5 lakh rupee and your investments are also there. Okay, like many people are doing that NPS. Okay, right? That NPS where the people are getting a benefit of 50,000 on depositing in NPS. So 15,000 rupees of the tax benefit is straight away coming to them. Okay. So friends, if I talk about this thing, this 15,000 rupees, so this is what tax planning. And what is tax evasion? For example, your salary is 10 lakh rupee and just by using the false income tax deductions, you are saving your taxes. So that is a tax evasion. Okay. So many companies are doing the tax planning strategy. Now, what standard says? Standard says that if you are doing a tax planning strategy, right, you have to recognize your deferred tax to the extent the taxable profit is probable less or net of the cost of implementation of tax planning strategies. Let's understand with the help of this example. The company has a taxable loss of 10 crore in FY 24-25. The company is probable that it will be able to generate taxable profit in next 5 years, aggregating to rupees 8 crore by implementing a tax planning strategy. So taxable loss of 10 crore, and in the next 5 years they will be able to earn 8 crore. The cost of implementation of the tax planning strategy will be 50 lakh. Tax rate is 30%. Advise the treatment of deferred tax in the books for FY 24-25. Friends, in this case, DTA will be recognized to the extent it is probable that future taxable profit will be available. In case of tax planning strategy, DTA will be recognized to the extent of taxable profit arised from tax planning strategy, net of cost of implementation. What is my expected taxable profit? 8 crore. Less cost of implementation is 50 lakh rupee. Net amount is 7.5 crore. So we will recognize deferred tax asset to the extent of 7.5 crore, right? So out of 10 crore on 7.5 crore, to that extent DTA will be recognized. So tax rate is 30%, DTA will be 7.5 crore multiplied by 30%. What is the accounting entry? Deferred tax asset account debit 2.5 crore to deferred tax expenses or deferred tax income, I would say 2.25 crore. This will be the accounting entry. I hope you guys have been able to understand this part. Friends, just give me a minute. Just give me a minute. Yes. Yeah. For tax treatment in case of business combination, very important. We'll touch upon this part and we'll go to the word file then. In case of business combination, you get fair value. Okay. In case of business combination, net assets acquired, fair value of the net assets and the carrying value of the net assets acquired. Example. So DTA or DTL, right? Deferred tax. Deferred tax has to be created on the difference between fair value of the net assets and the carrying value of the net assets acquired. Okay. For example, A Limited has acquired following assets and liabilities lying in the books of B Limited as on 31st March 2025. The carrying amount and the fair value arrived at the time of acquisition is as follows. Particulars. The carrying amount of the building is 50 lakhs, machinery 30 lakhs, bank balance 10 lakhs, total 90 lakhs. The fair value of the building on the date of acquisition is 80 lakh, machinery 40 lakh, bank balance 10 lakh only, and the total fair value of the asset is 130 lakhs. There was a trade payable of 15 lakh only, which was considered as 15 lakh as a fair value. And there was a deferred tax liability of 5 lakh also, which is also considered as 5 lakh. So this is the total carrying value and fair value of liability. If I talk about the net assets value, 90 minus 20, 70 lakh is the carrying value of the net assets, and 130 minus 20, 110 is the carrying value of the is the fair value of the net assets. Okay. So net assets is equal to this minus this. Okay. This is your A. This is your B. A and B. This is A minus B. Okay. A Limited has paid a purchase consideration of rupees 150 lakh on this transaction. Compute DT and DTL and goodwill on this acquisition. Tax rate is 30%. Okay. A Limited has paid a purchase consideration of rupees 150 lakhs. So what is the purchase consideration paid? 150 lakh. What is the fair value of the net assets acquired? 110 lakh. Compute DT and DTL and goodwill on this acquisition. So this question is a mix of Ind AS 12 and Ind AS 103. Tax rate is 30%. So how should we compute the DTA, DTL and goodwill on this acquisition? Might be you're thinking, sir, very simple. 150 lakh rupee we have paid purchase consideration. 110 lakh rupees the fair value of the net assets acquired. So 150 minus 110, 40 lakh is the goodwill, which is wrong. If you do that, 150 minus 110, it is wrong. It is wrong. Okay. So how should we compute that? Let me tell you. 150 lakh is the purchase consideration paid. Now, what is my net assets acquired? 80 lakh is the fair value of the building. 40 is machinery. 10 is the bank balance. 15 is the creditor. Now, first of all, in these kind of transactions, you need to compute your DTA, DTL first, then goodwill. And friends, tell me one thing. When this company was acquired by A Limited, in the books of the B Limited, these were the carrying values. These were the carrying values. And in the carrying value of the assets and liability, there was an item which was sitting, DTL. Deferred tax liability of 5 lakh was sitting here. What is the meaning of this 5 lakh deferred tax liability? It means as on 31st March 2025, the difference between the carrying value in the books of the B Limited, the carrying value of the assets and liability, and the tax base of the assets and liability, as per Income Tax Act and as per Ind AS, as per Companies Act. So the difference has created a deferred tax liability of 5 lakh rupee, right? Means as on 31st March 2025, this 5 lakh represent the difference between the book base and tax base of the assets and liabilities as on 31st March 2025. Do you agree with me or you don't agree with me? Yes or no? So what this DTL of 5 lakh represent the temporary difference, between the book base, which is carrying amount, right? Book base and tax base of the assets and liabilities of B Limited as at 31st March 2025. As at 31st March 2025. Okay. Right, friends. So this represents this. I hope it is absolutely clear to all of you. So DTL of 5 lakh. Explanation. DTL of 5 lakh rupee explanation. Okay. Yeah. So it means one thing is very clear. Whatever is coming in the books of, in the carrying value of the B Limited, this DTL, it already captured the temporary difference between the book base and the tax base up to this period. Means if we will change these values, like from 50 to 80, 30 to 40, 10 to 10, and these are remaining same. So this will create additional temporary difference, because by this fair valuation, your tax base will not change. What will change? Your book base will change. Yes or no? भाई टैक्स बेस तो इनकम टैक्स एक्ट के हिसाब से वॉट एवर यू हैव कंप्यूटेड एज पर इनकम टैक्स एक्ट, जो भी आपने कंप्यूट किया एज पर इनकम टैक्स एक्ट, you have already taken a DTL of 5 lakh rupee, right? So whatever increase or decrease you will create in the fair value, this will lead to an additional temporary difference, and this will lead to additional what? This will lead to additional DTA or DTL. Now friends, let's compare this carrying amount versus fair value amount, and let's discuss whether it is a DTA or DTL. Now What is the fair value of the net assets excluding DTL? So you have to remove DTL and then you need to compute what is my fair value of the net assets. Even if you will include DTL, the answer will not change. What is my fair value of the net assets? My fair value of the net assets excluding DTL is what? Is what? 115. And what is my carrying value of the net assets excluding DTL? 75, right? So 115 is my fair value of net assets. Carrying amount is 75. Difference is 40. Now, friends, again come to this thing again. So up to 75 of the carrying amount, we have already created a DTL. So now what is my book base? Now my book base becomes a fair value 115. What is my tax base? Let's assume it is 75 because up to 75 adjustment I have already taken that DTL of 5 lakh rupee, right? So 115 and 75, I need to reduce my net asset balance. Means I need to reduce my asset means I need to create a liability. This will impact in a creation of a liability. So difference is 40, tax rate is 30. What is my DTL? 40 multiplied by 30%. 40 multiplied by 30%, right? So friends, what was my DTL already created? 5 million. What is my DTL created on difference between fair value and carrying amount due to acquisition? 12 lakh rupee, 5 lakh and 12 lakh. 17 lakh is the total DTL. So now my purchase consideration is 150, net assets acquired at fair value is this much, and DTL is this much. So what is my goodwill? My goodwill was not 40, it is 52 lakh rupee. This is the computation in case of business combination. In case of business combination, right? I hope it is clear to all of you. Is that clear? Not clear? Clear? Okay. Let's discuss a question number 4 from ICAI Word file. Yes. Let's discuss question number 4. Question number 4. X Limited prepares consolidated financial statement to 31st March each year. Sir, whether every question is on consolidated financial statement, because when you talk about consolidated financial statement business combination, the calculation, no, I will not say calculation. So basically the concept become little complex. Okay. And at times it is prone to mistake also. Okay. But if your concept is clear, if you have learned the concept by your heart, right? So things will be very simple. And students, whomsoever is listening me, I just want to give you a guru mantra. First of all, consider yourself as a chartered accountant, not as a student. Doesn't matter whether you have appeared or not appeared in CA final examination yet. Consider yourself as a chartered accountant. Wherever you are studying, right? Wherever you are studying, just put a slip, put a paper in front of your workstation that you are a chartered accountant. For example, whatever your name is, let's say if your name is Karan Malhotra, right? It is a CA Karan Malhotra, okay? Or Karan Malhotra, chartered accountant. That is one. Number 2, do more and more practice. Do more and more practice, right? Because if your knowledge is limited, if your wisdom is limited, how it can be improved? It can be only improved by way of practice. The mind which government has given you, the mind which God has given you, not government, God has given you, you can skill your mind through practice only. Okay. Another aspect, or I would say another key takeaway from my side, if you want to take, try to correlate the concepts. For example, right now we are discussing Ind AS 12 income taxes, but we have also touched upon the concept of Ind AS 103 business combination, which says that the purchase consideration has to be measured at fair value, net assets has to be measured at fair value, and the resultant number is goodwill. So while computing the fair value of the net assets, you have to do the adjustment of deferred tax asset or liability also. Okay, which is a difference between the fair value of the net assets acquired minus carrying value of the net assets acquired, excluding DTA, DTL. Okay, right? So friends, if you will be able to relate the concept now, so while revising one concept, you will be able to revise another concept also. In the same time, you will be able to revise two or more concepts. It will save your time also. It will be just like a DTA, which creates a savings in future. Okay, right? So yes. Now let's come back to question number 4. X Limited prepare consolidated financial statement to 31st March each year. During the year ended 31st March 20x2, the following events affected the tax position of the group. Y Limited, a wholly owned subsidiary of X Limited, made a loss adjusted for tax purposes of 30 lakh rupee. So Y Limited, a wholly owned subsidiary of X, made a loss adjusted for tax purposes of 30 lakh rupee. Okay, right? They have made a loss of 30 lakh rupee. Okay. Y Limited is unable to utilize this loss against previous tax liabilities. Okay. So Y Limited is unable to utilize the loss. Income Tax Act does not allow Y Limited to transfer the tax loss to other group companies. And Y Limited is not able to transfer this loss to other group companies also. However, it allows Y Limited to carry the loss forward and utilize it against company's future taxable profit. But this tax loss of 30 lakh, it can be carried forward and set off against the future taxable profit for next 8 years, right? The director of X Limited do not consider that Y Limited will make taxable profit in the foreseeable future. But the director of X Limited says that they are not, expecting that Y Limited will be able to make profit in the foreseeable future, right? Friends, while this is a question of tax losses, and whenever there is a carry forward tax losses, unused tax losses, then deferred tax asset can be created. Deferred tax asset can be created on these unused tax losses to the extent of it is probable that these deferred tax asset will be recovered by the future taxable profit. So your deferred tax asset in case of unused tax losses will be recognized only to the extent it is probable that taxable profit will arise in future. In this case, the directors are not expecting the taxable profit in future. Will you recognize deferred tax asset? So in this case, no deferred tax asset has to be recognized because there is no prospect of being able to reduce tax liabilities in the foreseeable future as no taxable profits are anticipated, right? So in this case, no DTA, DTL, nothing has to be done. Second, just before 31st March 20x2, X Limited committed itself to closing a division after the year end, making a number of employees redundant. Therefore, X Limited recognized a provision for closure cost of rupees 20 lakh in its balance sheet as on 31st March 20x2. Restructuring provision as per Ind AS 37. This company has created a restructuring provision of 20 lakh. This company has created a restructuring provision of 20 lakh in the books of accounts. Okay. Income Tax Act allows tax reduction for closure cost only when the closure actually takes place. So right now they have only announced a decision, and as per Ind AS 37, this restructuring cost has to be, the provision for restructuring cost has to be taken in the books of accounts when it will arise in creating a constructive obligation. What is a constructive obligation? When the decision of restructuring has been announced to the impacted parties. When this restructuring decision has been declared and announced to the impacting parties, so restructuring provision has to be taken into the books of accounts. Okay. Why? Because it is creating a constructive obligation as per Ind AS 37. So now the company has created a provision in the books of accounts for 20 lakh rupee. But Income Tax Act says that I will allow you this 20 lakh rupee only in the future when you will close the division actually, right? In the year ended 31st March 20x3, X Limited expects to make a taxable profit which are well in excess of 20 lakh rupee. So, sir, what is the meaning of this line? In the next year, X Limited is expecting I will be able to make a profit of 20 lakh rupee, right? Taxable profit. On 31st March X2, X Limited has a taxable temporary differences from other sources which were greater than 20 lakh rupee. and even on 31st March X2, on some other item, X Limited has also a taxable temporary differences, means DTL. So tell me on this case, whether you need to take some impact of DTL, or you're not required to do anything. कुछ करना है या नहीं करना है? कुछ करना है या नहीं करना है? Sir, this restructuring provision has been created in the books of accounts, right? So liability in the books is 20 lakh rupee, but in Income Tax Act, it will be allowed only when the closure actually takes place, means zero. Tax base 0, book base 20 lakh liability. So now what to do? We need to reverse the liability. Deductible temporary differences of 20 lakh rupee. What is my tax rate? My tax rate is 20% given in the question, 20%. So 20 lakh multiplied by 20%, 4 lakh rupee of deferred tax asset is going to be recognized, right? So let's read this. The provision creates a potential deferred tax asset for the group since its carrying value is 20 lakh and its tax base is nil. This deferred tax asset can be recognized because X Limited is expected to generate taxable profit in excess of 20 lakh in the year to 31st March 20x3. Means it is probable that this DTA is going to be recovered, right? The amount of deferred tax asset will be 4 lakh, which is 20 lakh multiplied by 20%. This asset will be presented as a deduction from DTL caused by the larger taxable temporary differences. And in the question it is given, na, in the current year, the company has more than 20 lakh rupee of taxable temporary differences, means DTL is there. So this DTA will be netted off from the DTL, and net DTL is going to be presented in the books of accounts. Okay, clear? Now friends, read this question number 3. Read this question number 3. And what is this question number 3? During the year ended 31st March, 20x1, X Limited capitalized development cost which satisfied the criteria in paragraph 57 of Ind AS 38. During the year ended 31st March X1, X Limited capitalized development costs which satisfied the criteria of Ind AS 38. Okay. The total amount capitalized was 16 lakh rupee. The total amount capitalized was 16 lakh rupee. So it satisfied the criteria of development on 31st March X1, capitalization 16 lakh. The development project began to generate economic benefit for X Limited from 1st January 20x2. Okay, very good. The director of X Limited estimated that the project would generate economic benefit for 5 years from that date. Okay, from 1st January X2 to 5 years. The development expenditure was fully deductible against taxable profit for the year ended 31st March X2. So friends, what is the total amount? The total amount capitalized was 16 lakh rupee. Okay. And this was capitalized during 31st March 20x1. 31st March 20x1 it was capitalized, right? So friends, the total amount capitalized was 16 lakh rupee, and this development started economic benefit from 1st January 2002. From 1st January 2002. Okay. Right. And the director of X Limited estimated the project would generate economic benefit for 5 years from that date. The development expenditure was fully deductible against taxable profit for the year ended 31st March 20x2. Okay, 20x2. So my dear friends, what is the carrying value of the development cost and 31st March 2002? So friends, if I talk about this question, just a minute. So what is my carrying value of development cost as on 31st March X2? What is my carrying value of the development cost? So this has started giving the economic benefit from 1st January X2. So in the last quarter, in year 20x1 X2, the depreciation, the amortization has to be charged only for 3 months. Okay. 16 lakh 16 lakh is the 16 lakh is the capitalized amount. So I need to charge an amortization of 16 lakh divided by 5 for the full year. But in the first year ended 31st March X2, this amortization has to be charged only for 3 months. So 16 lakh minus 16 lakh divided by 5 multiply by 3 divided by 12. You need to charge an amortization only for 3 months in 20X2, right? This will give you a carrying value of 15 lakh 20,000. But what about the tax base? What about the tax base? Book base we have understood. You guys have understood the book base, na? भाई book base कैसे निकाला मैंने? What is my carrying value as at 31st March X2? 16 lakh minus 16 lakh divided by 5 multiply by 3 divided by 12, right? So what is my depreciation? 16 lakh divided by 5 comes at 3 lakh. How much? 3 lakh 20,000. 3 lakh 20,000 divided by 4, 80,000. So my amortization is 80,000. 80,000. Okay. So 16 lakh minus 80,000 is equal to 15 lakh 20,000. 15 lakh 20,000 is my carrying value, is my books value, intangible asset. What is my tax base? In the tax books, it is written that development expenditure was fully deductible against taxable profit. So in the tax base, it is 0 and the asset value is 1520. So what should I do? I should reduce my tax asset. I should reduce my asset, means I should create a liability. A DTL will be created, a taxable temporary difference will arise. Okay, right? So a taxable temporary difference will arise for what? 1520 multiplied by 20%. Okay. The carrying value is 1520. The tax base is 0. So deferred tax liability will be 15 lakh 20 multiplied by 20%, 3 lakh 4,000. All deferred tax liabilities are shown as non-current. Okay. Let's go to the question number 4. On 1st April 20X1, X Limited borrowed 1 crore rupee. The cost to X Limited of arranging the borrowing was 2 lakh rupee, and this cost qualified for a tax deduction on 1st April 2001. So this 2 lakh rupee has to be shown as a allowable expenses while computing the tax liability. The loan was for a 3-year period. This loan was for a 3-year period. No interest was payable on the loan, but the amount repayable on 31st March 20X4 is 1 crore 30 lakh 43,800. Friends, as per Ind AS 109, this loan has to be computed on the fair value, which is amortized cost, right? And interest expense has to be taken on the basis of effective interest rate method, EIR method. Effective interest rate method. Interest cost has to be taken on the basis of EIR method. Effective interest rate method. Okay. Effective interest rate method. Right. So what is given in this question? In this question, it says that the loan was for 3-year period, and on 31st March 20X4, the amount is 130,43,800. This equates to an effective annual interest rate of 10%. As per the Income Tax Act, a further deduction of 30,43,800 will be claimable when the loan is repaid on 31st March 20X4. When the loan is repayable on 31st March 20X4, right? Friends, first of all, the EIR is given in this question, which is 10%, right? And you are required to compute DTA DTL in the consolidated balance sheet as on 31st March X2, and this 31st March X2 balance is not given. So how will we compute it? Let me take you onto the Excel file. Okay. So question number 4, right? Question number 4, point number 4 of Word file. Computation of carrying amount of loan as per EIR method on 31st March 20X2. So what is my amount of loan which I have taken? What is my amount of loan which I have taken on 1st April 20X1? 1 crore rupee, right? 1 crore rupee. So loan amount at inception 1 crore rupee. 1, 1, 2, 3, 4, 5, 6, 7. 1 crore rupee. Okay. Less. What is the less? Transaction cost. There was a transaction cost, na 2 lakh rupee of arranging the borrowing. Transaction cost. So in your books of accounts, whatever is your transaction cost, you have to reduce from the loan transaction cost. Net, what you have received? You have received net 98 lakh rupee. You have received net 98 lakh rupee. Okay. At the inception. Okay. Net amount received. Net amount of the loan which the company has received. Net amount of loan. Now, friends, this is the net amount of the loan. Now, tell me, in the question, it says that there is an effective interest rate of 10%, right? What you have to pay? You have to pay the principal amount of 1 crore in 3-year period. The loan was for a 3-year period. Okay. No interest was payable on the loan, but the amount repayable on 31st March 20x4 will be 130,43800, right? So basically, the amount which you have taken, net amount 98 lakh. So after 3 years, this will become how much? This will become 130,43800. This will become 130,43800 at the time of maturity. 130,43800 at the time of maturity. And EIR is 10%. So tell me, what is my carrying amount of loan? What is my carrying amount of loan on 31st March 20x2? So opening balance which is 98 lakh plus add interest at the rate of effective interest rate of 10%. Right? So this 107,800, right? 107,800, right? 1 crore 7 lakh 80,000. 1 crore 7 lakh 80,000 will be my carrying value of the loan. But what is the tax base of the loan? लोन का टैक्स बेस क्या है? It is 1 crore only. The tax base of the loan is 1 crore only, right? The tax base of the loan is 1 crore. Yes or no? How many of you agree with me that the tax base of the loan is 1 crore? How many of you will agree with me the tax base of the loan is 1 crore? Because this 2 lakh rupee, see, this 2 lakh rupee has been allowed as a deduction. This is allowed as an expense, right? So 1 crore 7 lakh 80,000 minus 1 crore, right? So the carrying value of the loan is 1 crore 7 lakh 80,000, which we have discussed. And the tax base of the loan is 1 crore. Okay. And this creates, so the liability in the books is 1 crore 7 lakh. The liability in the tax is 1 crore. So we need to reduce the liability, means create a deferred tax asset, means create a deductible temporary differences of 7 crore 7 lakh 80,000, right? So there will be a DT of 1 lakh 56,000. Okay. 1 lakh 56,000. Okay. Right. Is that right, friends? Is that right? Yes or no? Tell me. Is that right or not right? Yes. Okay, now the time has come. To discuss some multiple choice question. Okay. Shall we discuss some multiple choice question? Yeah. Okay. Let's discuss some multiple choice question. Let me open my file on MCQ. Just a minute. Allow me a second. Okay. Just a minute, friends. Let me open my file. Yes. Yeah. I hope my MCQ file is visible. Is it visible? Not visible? Is it visible or not visible? Okay. Okay. Just a minute. Is it visible now? Is it visible now, my dear friends? Yeah. So question number one. An entity has unused tax losses of 50 million rupee. A deferred tax asset shall be recognized always since tax losses provide future tax benefits only when it is probable that future taxable profit will be available against which the losses can be utilized, only when the tax authority approves the recognition, never since tax losses are contingent assets. What is the right answer? An entity has unused tax losses of 50 million. So DTS will be recognized to the extent it is probable that future taxable profit will be available against which the losses can be utilized. B is the right answer. Question number two. Deferred tax is not recognized on initial recognition. Deferred tax is not recognized on initial recognition of an asset or liability if the transaction is a business combination, so it has to be recognized. The transaction affect accounting profit but not taxable profit, it has to be recognized. The transaction is not a business combination and affect neither accounting profit nor taxable profit at the time of transaction. If the transaction is not affecting your accounting profit or taxable profit, it is a balance sheet to balance sheet transaction, right? So whether deferred tax asset is going to be recognized, you have purchased a machinery on the day one, will you recognize DTA DTL? Of course, no. Of course, no. Machine account debit to bank. Same entry will be passed in books of account. Same entry will be considered in income tax act also. Right? So deferred tax is not recognized when the transaction is not a business combination and neither it affect accounting profit nor taxable profit at the time of transaction. Revaluation of PPE. An entity revalues, sorry, an entity, just a minute. An entity revalues land upwards means revaluation surplus. The under Ind AS section, the tax base remain at historical cost. Which statement is correct? So the tax base, so the value of this land under Income Tax Act, they will consider the historical cost only. They will say that we will only consider this gain or loss at the time of sale, but we will not understand revaluation model. But in Ind AS, revaluation model is allowed. So the company has revalued the land. Which statement is correct? No deferred tax arises until the land is sold. So if the company has done the revaluation, the land value has gone up, but in the tax base it is a historical cost. Of course, there is a temporary difference. Okay, so this statement is not correct. This statement is not correct. A taxable temporary difference arise requiring recognition of deferred tax liability. Right. So there is a upward revaluation. So your book base of land is higher than the tax base. So you need to align. This is an asset. You need to align your books with tax. So what you need to do? You need to reduce the asset. Reverse the asset means creating a liability, means creating a taxable temporary differences. So a taxable temporary difference arise requiring recognition of deferred tax liability. B is the right answer. Deductible temporary difference, no. Deferred tax is recognized directly in P&L, no. So why this statement is incorrect? So friends, revaluation surplus, we will read tomorrow. Revaluation surplus on PPE will go to other comprehensive income, and deferred tax on OCI items, is recorded in OCI only. Okay, is OCI only. Investment in subsidiary. Okay, so investment in subsidiary. A parent shall recognize deferred tax liability on taxable temporary differences relating to investment in subsidiary unless The investment is classified as held for sale. So parent shall recognize DTL on DTL relating to investment in subsidiary unless the investment is classified as held for sale. The parent can control the timing of reversal of the temporary difference, and it is probable that the temporary difference will not reverse in the foreseeable future. The subsidiary is foreign, dividend is exempt from tax. Okay. So B is the right answer. What B says that the parent will recognize a DTL if parent can control the timing of reversal of the temporary difference. Okay. In the console accounts, with the deferred tax relating to the investment in subsidiaries, the parent will recognize a deferred tax liability if parent can control the timing of reversal of the temporary differences relating to the subsidiaries. Okay. Now, tax base of the asset. What is my tax base of the asset? The carrying amount of the machine is 120 lakh. It has WDV of 90 lakh. Applicable tax rate is 30%. Right? So carrying amount is 120 lakh and WDV is 90 lakh, means textbooks. So book base is 120 lakh, tax base is 90 lakh. Book base is 120, tax base is 90. We need to reduce. We need to reduce means we need to reduce asset, means create a liability. Taxable temporary differences. DTL on 30 lakh. 30 lakh multiplied by 30%, 9 lakh. So DTL of 9 lakh. Right? This is the right answer. Current tax recognition. So current tax recognition. Current tax relating to item recognized in OCI should be recognized always in P&L, directly in OCI, directly in equity as deferred tax. So normally, my dear friends, it is not about current tax, right? So it is a deferred tax only. It is a deferred tax only. So this tax has to be recognized for OCI related item. Tax has to be recognized in OCI only. Tax has to be recognized in OCI only, right? Measurement of deferred tax. Measurement of deferred tax. So talking about a measurement of deferred tax. Deferred tax assets and liabilities are measured using tax rates expected to apply when the temporary difference originate. Enacted or substantially enacted or substantively enacted tax rates expected to apply when the asset is realized or liability settled. Average rate of previous 5 years, current effective tax rate. This is not right. This is not right. Current effective tax rate or enacted or substantively enacted tax rate expected to apply when the asset is realized or liability is settled. When you are talking about deferred tax, you are talking about future, right? So up to the reporting date, as on the reporting date, if a new tax rate has been substantively enacted, right, which is expected to apply for future, so that tax rate has to be applied for measurement of deferred tax. Already enacted or substantively enacted tax rate which is expected to apply in future. Okay. Offset of deferred tax. Deferred tax assets and liabilities shall be offset when they relate to the same temporary difference. They relate to the same taxable entity and the entity has a legally enforceable right to offset current tax and liabilities. They arise in the same financial year and they are recognized in OCI. What is the right answer? When they relate to the same taxable entity and the entity has a legally enforceable right to offset current tax and current tax liabilities, asset and liabilities. Deferred tax asset on fair value adjustment in business combination. During acquisition of a business, inventory is stepped up to fair value without an equivalent increase in tax base. During acquisition of a business, inventory is step up to a fair value without an equivalent increase in tax base. Tax base remains same, but fair value has increased. The acquirer should ignore deferred tax because the difference arose in a business combination. Answer is no. We have specifically read that in business combination, when there is a difference between the fair value of net assets acquired and the carrying value of the net assets, there has to be deferred tax implication. So this is not a right answer. Recognize deferred tax liability as part of acquisition accounting. So this asset has a higher value, tax base has a lower value. So you need to reverse asset means create a liability. So you need to recognize deferred tax liability as part of acquisition accounting. DTA is wrong, amount in OCI is wrong, right? So friends, this was the MCQ. I will share the MCQs also, right? I will share the MCQs also. So friends, what we have covered so far, we covered the meaning of current tax and the meaning of deferred tax. Then we have covered, after that, what we have covered? After that, we have covered that what are the accounting entries of current tax, and we did a comprehensive question having a 10 points on the computation of current tax. Then, friends, we have covered the steps of deferred tax. What is meant by deferred tax? So, deferred tax means when you are preponing or postponing your tax liabilities, right? It is considered as a deferred tax. Then there are few steps of deferred tax. Number one, you need to compute your carrying amount or book base. Then you need to compute your tax base. The difference between book base and the tax base is considered as a temporary difference, right? It could be a taxable temporary difference. It could be deductible temporary difference. If it is a taxable temporary differences, it is a deferred tax liability. If it is a deductible temporary difference, it is deferred tax asset. Then you need to apply the tax rate which is enacted or substantively enacted on or before the reporting date. You need to apply the tax rate to the temporary difference to arrive at the DTA and DTL. If it is DTA, accounting entry is deferred tax asset account debit to deferred tax income account. If it is DTL, the accounting entry is deferred tax expense account debit to deferred tax liability account. This DTA and DTL has to be always shown as a non-current asset and non-current liability. This DTA and DTL can never be discounted. This DTA and DTL can be offsetted, right? If it is relating to the same legal entity and the entity has a legal right to offset it. Okay. So then, friends, we discuss some specific point. If it is a permanent difference, no DTA DTL is going to be created, right? Friends, for the unused tax losses and tax credits, the DTA and DTL has to be recognized to the extent it is probable that the future taxable profit will be there. Okay. Third, if the company has an unused tax losses and the company is creating a deferred tax, and the company has some tax planning strategies. So whatever taxable profit the company is expecting from the tax planning strategy minus the implementation cost of tax planning strategy, to that extent, the company can create a deferred tax asset. Okay. So friends, we discussed lot of examples, lot of questions on the creation of DTA and DTL. Okay. I hope this is clear to all of you. Yes. Great. Great, my dear friends. So I hope you enjoyed the session thoroughly. So if you have any question, would be happy to answer. Otherwise, I would be happy to conclude the session, right? Thank you so much, my dear friends. Thank you so much. Bye-bye. Take care. The session is over. Thank you.